All right, I see the numbers were climbing up and have settled down a little bit. So I think that's lots of our attendees for now. So thanks very much, everyone, for joining, and really welcome to this morning of training on the IFRS Sustainability Disclosure Standards. This has been a very collaborative effort to get to this training session, driven by that demand that we're seeing from the market to really understand the IFRS standards. So we'd just like to say, firstly, as we start, our thanks to the Dar es Salaam Stock Exchange for having us and supporting us in hosting this session today. It's greatly appreciated. We also have the IFRS Foundation, IFC, and Bloomberg Philanthropies as our key partners in this initiative, who we're very grateful for in their support and participation. And finally, of course, thank you to yourselves for joining us on today's session. We do very much appreciate that as well. So I'll be going through some housekeeping comments in a moment just to walk through the agenda and some practical points. But before I do, we're very happy to have Peter Nalitalela joining us from the DSE. He's the Chief Executive Officer, and he'll be delivering a few opening remarks just to get us started. So thanks very much, Peter, for joining us, and hand over to you for those remarks. Thank you.
Okay, thank you, Fiona, and thank you everyone for joining us. Ladies and gentlemen, distinguished guests and esteemed participants, good morning and welcome to this important workshop on the latest sustainability disclosure standards set forth by the International Financial Reporting Standards, the IFRS. It is a great honor for me to open this live and interactive session, which is not only a testament to our commitment to fostering sustainable practices within our financial markets, but to also have a unique opportunity for all of us to deepen our understanding of ESG principles. As the CEO of the Dar es Salaam Stock Exchange, I'm proud to host this training workshop, facilitated by leading experts from the IFRS Foundation, the UN Sustainable Stock Exchange Initiative, and the IFC. Their expertise and insights will be invaluable as we navigate the complexities of sustainability reporting and its implications for our markets. Today, we're here not just to learn about compliance, but to embrace a broader vision, one that recognizes the critical role that transparency and accountability play in enhancing the sustainability of our capital markets. With increasing global emphasis on environmental, social, and governance practices, it is imperative that we equip ourselves with knowledge and tools to meet these evolving standards. In June last year, the International Sustainability Standards Board issued its first IFRS Sustainability Disclosure, IFRS S1 General Requirements for Disclosure of Sustainability-Related Financial Information, and IFRS S2, which covers climate-related disclosures. This is a reflection of the changing approach and thinking about what it means to run an organization, be it a for-profit, a non-profit, or governmental entity. Traditionally, we used to focus on the bottom line in monetary terms, and we had reporting standards to guide us on how we report that. But increasingly, the focus has shifted to a balanced quadruple bottom line of profits, people, planet, and purpose. The sustainability standards aim at setting forth standards on how we report these other aspects of the bottom line, meaning people, planet, and purpose. The IFRS sustainability standards were therefore developed to enhance investor-company dialogue so that investors receive useful, globally comparable, sustainable disclosure for decision-making. As the exchange, the DSE has in recent years seen successful issuances of sustainability bonds, evidenced by the investor appetite on one part, as these bonds were heavily oversubscribed, but also the fact that a number of these bonds had been successfully cross-listed in other exchanges give credit to the fact that there is indeed appetite on both the investor side as well as the issuer side. And there's definitely a pipeline for more issuances to come soon. This workshop therefore comes at the right time for all market participants, namely issuers, brokers, transaction advisors, including accountants, auditors, risk reviewers, and regulators. This workshop is being offered free of charge to all market participants, and we thank our sponsors for that, and reflecting our commitment to inclusivity and capacity building within our financial ecosystem. We believe that empowering our members with the necessary skills and knowledge is essential for fostering a resilient and responsible market. I also want to highlight that this workshop takes place in the lead up to the DSE Members Awards event that will take place on the 8th of November 2024. This event will recognize ESG practices among our members and celebrating those who are not only committed to financial success, but also sustainability of our communities and environment. I encourage all participants to embrace these principles as we work together towards a more sustainable future. And I look forward to an engaging discussion and valuable insights that will emerge from today's session. And let us seize this opportunity to learn from each other, share best practices, and collectively drive the advancement of sustainability in our markets. Thank you to our participants, and let us embark on this journey together.
Thank you very much, Peter, for that great introduction. I think that sets the scene really well for today's session, and we really appreciate you joining us for this opening. Brilliant, thank you so much. So we'll move on then to a few housekeeping points from my side before we get into the interesting start of the content. But just a few things to clarify. So firstly, you will notice that you are, if you're a participant, you're on mute at the moment. That's just to enable us to move through the session because we have lots of content to do. However, we really would like to hear from you. So please do engage throughout the session using the chat and the Q&A functions. You'll see those available for you at the bottom of the screen. So please use chat to share any welcome messages or to share your comments or perspectives. And then please make sure if you have any specific questions that you enter those in the Q&A box because that will enable us to keep track of those questions and to write our responses to them. So those are just two key functions to be aware of as we move through the session. So as you know, today's session is 3.5 hours. There will be a little break in that as well, as we know it's quite a long time for everyone to be concentrating. Please, as we say, do continue to ask your questions live throughout. We have a great panel of experts here with us today who'll be happy to answer your questions. So make sure you use that opportunity to get them to answer your questions and to give your perspectives there. We will also have the opportunity, if you want to upvote any particular questions that you would like to see answered. So please give them a thumbs up in the Q&A panel so we can make sure we prioritize those questions as well. We will also be getting your participation throughout the session, as I mentioned. So we'll be using the polls within Zoom. We will also be using Mentimeter, which we'll walk through using to do some interactive exercises. And there will also be a homework assignment as well, which is entirely voluntary, but is a great way, obviously, to continue to further your knowledge and thinking on this topic. So we'll explain a little bit more about that later in the session. You also, if you are attending this session live, entitled to receive a certificate for participating in the training session. This will be possible by completing the feedback survey, which will come to you after the webinar has finished. So just to be aware of that as well. Great, so that's all of my practicalities out of the way. And then time to do just a couple of introductions to who you have on your panel today. So firstly, I'm Fiona from the ISSB team. I'm one of our training officers here, so I'll be facilitating today's session. I also have my colleague Landon joining me, who is our project officer, and he'll also be covering some of the content. Then from the IFRS team, our real experts in the room, we have Jarlath Malloy, the Director of Strategic Affairs, who supports IFRS's capacity building programme and leads its internal sustainability team. And joining Jarlath, we have Robert Swiatowski, who is the Partnership Manager for Capacity Building. He's recently joined the IFRS Foundation and brings with him a wealth of experience in both sustainable finance and audit as well. So definitely make sure you make use of having these guys attending today to get your questions answered. And then from our IFC partners, we have two colleagues joining us. We have Relitsa Germanova, ESG officer and lead for the Sustainability and Climate Disclosure Transparency Programme at the World Bank's IFC. And then further, we have Rose Lumumba, a corporate governance specialist who works in IFC's Africa Corporate Governance Advisory Programme. And so before we dive into the content, I will just quickly turn to Relitsa and Rose just to check whether you'd like to make any brief opening comments as well.
Thank you. Thank you very much, Fiona. And ladies and gentlemen, good morning and welcome to this virtual training session on IFRS Sustainability Disclosure Standards S1 and S2 We are honored to have you join us today for this important event, and I would like to extend a warm welcome on behalf of the International Finance Corporation, a member of the World Bank Group. Today's training is a result of the partnership between IFC, the UN Sustainable Stock Exchanges Initiative, and the IFRS Foundation, aimed at strengthening sustainable capital markets by enhancing sustainability and climate reporting in emerging markets and developing economies. And our joint efforts will ensure that those markets are not left behind in the global shift towards sustainable finance. We are delighted to collaborate with the Dar es Salaam Stock Exchange in delivering this training, which we started in January this year, and we are seeing an overwhelming interest from different markets. We have trained over 10,000 people so far, and we have a very booked agenda ahead. This partnership marks the beginning of a meaningful collaboration between our Tanzania country office and Dar es Salaam Stock Exchange, with the aim of deepening Tanzania's country's compliance with global sustainability standards. And we believe that this training will equip participants with the necessary knowledge and skills to effectively implement and disclose sustainability and climate-related information in line with international best practices. And by doing so, we can enhance transparency, attract responsible investment, and contribute to the sustainable development of Tanzania's capital market. Once again, thank you for joining us today, and we look forward to a productive and engaging training session. Thank you, Fiona.
Many thanks, Ralitza. That's much appreciated. Great. So with that, we'll now be moving into a little bit of an overview of the content. So we have 3 key learning objectives from today's session. So firstly, we'd like you to come away with an understanding of the ISSB standards and what they are. We'd then like to hope that you can understand how to use the standards. And finally, that you'll be able to identify what steps that you can take to develop a disclosure plan to apply the standards. So breaking that down really into some key activities that we'll be undertaking and the structure of our approach, we'll be working across these 4 core areas that we show on the screen. So we have 4 modules aligned to these steps here. So firstly, if we start with prepare, that's really about building on your knowledge, understanding the landscape and the global baseline for what's in place at the moment. Align is then all around setting that direction. So understanding how you apply and use the standards, thinking about the additional disclosures that you might need to add to meet those requirements. When we move into implement, we're thinking here about practices and systems, so how that you can really identify, value, and integrate those risks and opportunities from sustainability into your reporting. And then finally, we end on communicate. So this is really that final format, how you prepare your reporting, where you put it, and how you do so in a kind of confident and a efficient way. So that's the structure that we'll be working through in today's session. And so to do that and to meet those objectives, we have an agenda here. We'll be having a break midway through the session between those modules, just to give you a short stretch of the legs, as we do know it's quite a long time to concentrate. As we've already said, please do feel free to ask your questions throughout the sessions. Obviously, the speakers will be taken in turn, so the rest of us will be very happy to be monitoring those questions in chat while we're not talking, so please make use of that. And then further, we'll be sharing lots of resources with you in the chat and in the resources that are available for you to take away from this session to give you lots of ideas. So we just highlight a few key things here. If you go onto our SSE website, you'll be able to find under the Academy section all of the resources from today's session. And the link to the specific page for Tanzania will be shared with you in the chat, or I believe already has been. So on that page, you'll be able to find the slide handout from today, the homework exercise that we'll be asking you to take away if you'd like to. And finally, when we have the recording from today, that will be made available there as well. And as I've mentioned, we have a brief homework assignment. So the idea of this will be to develop a draft disclosure plan for your company, to use what you've learned today and put it into practice. So it's not mandatory to do this. It's really just if it's valuable for your own learning. And it's not something you have to submit to us in any formal way. But again, the link to that will be on the webpage that's been shared with you in the chat. And it's really just for you to start your conversations internally and to build on the understanding that you developed today. I'd also just briefly highlight the SSE toolkit that's available from our website, a number of key guidance tools and training supports that you can use to better understand these topics. We have model guidance on sustainability related financial disclosure for stock exchanges. That's to help them with getting started and giving their issuers guidance on this topic, as well as a number of other resources you see mentioned here that really help you to understand some particulars around climate change, and also to think about how to do a gap analysis against those sustainability related financial disclosure requirements. So with that, I think I've been talking for a little while, but we'd now really like to hear from you. So we'll be doing a brief question in Menti and just to test out using Menti's functionality. So if you see on the screen there, if you go to menti.com, and we'll be sharing a code with you in the chat. There will also be a direct link shared in the chat to the Menti poll, which is probably the easiest option. So please do click on the link that will be shared in Menti shortly, and then we will take you through a number of quick questions. Great. So Landon, I'm not sure if you have been able to share that one. If not, I can do so. Yes, there we go. So great, thank you for that. So if you click on the link there, and then I will just share screens with you to show the Menti. So just take a second to get into the session. But if you see on the screen here, you can also use the code that should be showing to you at the top of the screen, or the QR code there at the bottom as well to access. So if you'd just like to share with us in a few words what you're hoping to get out of today's session or why you've joined us, I'll just give you a second to respond to that. We will be using Menti for a number of other exercises throughout the session, so worth just taking that moment now to make sure you can access it. Great, I see some responses coming through quickly here. So we have learning, applying, knowledge, increasing your understanding, trainer. Yeah, absolutely. I think that's great that if you'll be able to take away the knowledge you have from today to train those within your own organization, learning from others, compliance, upskilling, be an expert. That's the hope, definitely, in sustainability reporting. So yeah, lots of good aims there, and I think hopefully things that we'll be able to support you with in today's session. So thanks, and do feel free to keep sharing those in the background. I'll leave that open for you. Great, so we'll just return to the presentation now. Oh no, I'm sorry, we do have one more question for you in Menti before we do so. That's my mistake. So I will reshare my screen and move on to the second Menti question that we have for you just to start. So what we'd like to just check with you all as well in Menti is to get a sense of how comfortable you are currently with this content. So if you could just use the sliding scale there from not comfortable at all on the left-hand side to very comfortable, to give us a sense of how comfortable you think you are at the moment with explaining the ISSB, using the standards, and developing a sustainability reporting strategy. Lovely. I see some responses coming through for this one as well. That's great. Okay, so most people it's moving up the scale slightly, I see there, but most people indicating they're a little bit closer to not comfortable at the moment, and that's absolutely fine. Of course, we understand this is why you're here to learn today, so that's no problem, but that's very useful for us to get that sense. So thank you for sharing that. Great, thank you for that. So we'll now be returning to the presentation to start on the first segment. And before I do so, I just have a brief disclaimer that I'll just leave on the screen for you for a moment. We just wanted to be clear that we'll be using a few examples in the materials today. And we wanted to make it clear that these examples are really to help add some color to what we're talking about and to give you some, real examples of practice of what we're talking about. However, you should know that the examples we're sharing may not be seen as the best way or perhaps even the right way for your company, and that we completely understand that your circumstances may differ to these companies, or indeed what maybe the better approach may be different. However, we hope that they can give you a little bit of inspiration to get started with. Great, so with that point clarified, I will then be moving into module 1. So I'll be starting us off here before I hand over to some colleagues. So you will get a little bit of a flavour of different perspectives as we move through this. But starting in our first module, which is all around building a solid foundation of knowledge and looking at what you already know and how these standards actually build upon a lot of what's already out there. So in this first unit, to build a solid foundation, we generally like to cover 3 important aspects. So why to disclose sustainability information, how the landscape of disclosure has evolved to reach the ISSB standards, and finally, an overview of the standards themselves. So in this first unit, we'll be thinking about the purpose. So that's the case for sustainability related reporting and the market and business case for it. We'll also be talking about the landscape. So that's how the reporting landscape has evolved, including how it's becoming simplified. And then finally, we'll be thinking about the global baseline. So the core concepts and requirements in IFRS 1, S1, and S2 that form this global baseline. And to kick us off within that, particularly on the purpose phase, we'll be getting started with why. So looking at the purpose or the why aspect, and we'll dive into the case for disclosure and market drivers. And before we do that, we have a brief Zoom poll that we'd like to ask you to get a sense of what your drivers are. So that poll will be shared with you momentarily. There we go, it should be on your screen now. So we'd like to know from you, you can tick as many of these answers that apply for your organization. What are your reasons for disclosing sustainability related information? So take a moment to look at those options and let us know which ones are most applicable for you. So I'll just give you a moment to respond to that. Great, I see we have around 30, coming up quickly, 40% of participants responded here. So we're seeing regulatory requirements and investor interest at the moment as the front runners, but some of you also are talking about your management objectives as well. But yeah, particularly those 2 are coming out top here, which I think is unsurprising, and obviously is the reason a lot of us are coming to this. So I will just share those results with you so that you can see the final numbers that we got to there from those responses. So thanks everyone for sharing there. Great, so you should just be able to close that from your screen, and we'll move back into the slide presentation. Great. So I think, as I said, drivers, investor interest clearly is a key driver that many of us see. And I think one thing that really illustrates this well is the number of investor signatories we see to the Principles for Responsible Investment initiative. So you'll see that we're now actually up beyond this scale at 5,000 signatories to these principles, representing more than $121 trillion in assets under management. So really, we can see that there's been that huge growth in investor focus on sustainability and responsible business issues. So what is it that's really driving this interest from the investor community? I think what's important to highlight here is that a key driver behind this demand from investors is indeed the financial effects of sustainability. Here we have some data from a study of retail investors, which was conducted by Morgan Stanley, where they found that actually the top driver of at least individual investors that was driving their interest in sustainable investing was actually financial performance. So nothing altruistic in that sense, but really, understanding that actually these sustainability related risks and opportunities had a direct connection to the financial performance of their investors. And you can take a closer look at the study within the handout, where you will see the link is available for you at the bottom of the screen there. But let's take a little bit of a closer look before we move on as to what we mean by financial performance, because I think that's quite a key concept to establish. So it's important to remember what we're talking about, disclosing financially material sustainability related information. So while we discuss more in depth in the workshop what the word material means, we wanted to be clear from the start what sort of financial effects investors are looking for more information on. So starting with the effects on a company's performance, which is often seen in the statement of profit or loss, which shows your income or revenue and your expenditure. Sustainability-related risks and opportunities can have a financial effect by changing the revenue mix or total revenue of a company if its demand for products and services change, for example. And we could also see substantial changes in expenditure, so increased operating costs or greater expenditure needed on R&D as a result of sustainability-related risks and opportunities. We then also talk about financial position. And so what that means here is thinking about the company's financial position on the balance sheet, thinking about both their assets and their liabilities. We might see changes to portfolio value or even write-offs of assets as a result of sustainability-related risks. And we might also see changes to financing and the cost of capital, for example, through increased insurance premiums due to climate risks, or also due to making of new financing structures such as green or social bonds. And before we move into the next unit, we also just wanted to flag two important aspects of sustainability-related risks and opportunities that are really essential to our understanding here. So as you can see from the latest Global Risk Perception Survey from the World Economic Forum, risks can evolve over time, and something that may pose a risk in 10 years from now might not be that high on our mind today, as you can see from the difference in this World Economic Forum report as to what both near-term and longer-term risk types are. And it's really important when we're thinking about our disclosures that we're preparing for those risks that may arrive in 5 to 10 years or now, so that we're actually investing today in the new practices or processes that can mitigate those future risks. But of course, what that might mean is that we actually see financial effects much earlier as a result of those risk management actions we're needing to take. And another important thing to highlight is actually that interconnection between risks and opportunities. So another report we have here from the World Economic Forum, from the same report, shows that real interconnection between different risks types. So many people might think of the two ISSB standards, S1 and S2, as separate things, one for climate and one for other sustainability related topics. However, what you can see here is that all of these sustainability related risks and opportunities are very much interconnected. And so separating out one topic or theme doesn't remove those interconnections. And we really need to think in a holistic way when we're making strategic decisions and dealing with these risks and opportunities. So when we're disclosing information on climate risks under IFRS S2, we must also be thinking about the requirements of IFRS S1 as they relate to disclosure of climate information. Great. So thanks everyone for that. I will now be handing over to Landon, who'll be taking us through the next segment of the training.
Great. Good morning, everyone. Great to see everyone here, and thank you for attending. So the next section we're going to cover is a little different. So we've covered briefly the why. So now let's look at how the IFRS sustainability disclosure standards developed in the landscape of existing reporting standards. And with that, we're going to move to a Zoom poll to see what, if any, frameworks are you currently using, and you can select all that apply since sometimes you're utilizing more than one. So give me 1 second and I'll pop up that poll. Okay, and you should now see it on your screen. Then I'll give folks some time to answer. Okay, we're seeing a lot of GRI, a lot of integrated reporting, ISSB, still a few TCFD. Okay, give folks a few more seconds. It's interesting for us to see what countries and regions are more focused on which frameworks at the time. Okay, I see things slowing down, so I'll end the poll there. So as you can see, it seems like a slim majority are integrated reporting, but lots of folks are using ISSB and GRI still. So thank you for answering that question. And now we want to take 1 second here as I change slides. Okay. So moving along, sorry, Fiona, do you mind changing the slide? I'm having difficulties on my side. Thank you. So now we'll take a moment now to understand what the IFRS Foundation is and how the ISSB came to be. So the IFRS Foundation is a not-for-profit public interest organization established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. So the IFRS Foundation hosts 2 independent standard-setting boards. The first, the International Accounting Standards Board IASB, formed in 2001, and these standards are in place in over 140 jurisdictions around the world. And the International Sustainability Standards Board, ISSB, which was formed more recently in 2021, and it released its first 2 standards in 2023, following strong market demand for the establishment. So the governance there is provided by trustees who are in turn accountable to a monitoring board of public authorities, and ISSB works closely with IASB to ensure that their standards complement each other. Okay, great. So yeah, I have slide control again, thank you. So now the evolution of reporting standards. So all these organizations have contributed to the evolution of sustainability reporting. And in fact, they all have a lot in common, but the range of objectives, guidelines, and standards on offer has caused some confusion in the market. You know, sometimes this is referred to as an alphabet soup. So most of these organizations here focus on meeting investor needs for sustainability information, except for GRI, which supports a broader range of stakeholders. Some of these organizations consolidated into the IFRS Foundation to form the basis of the IFRS Sustainability Disclosure Standards, but the standards were also built on the TCFD recommendations. So those of you who have been reporting in line with this TCFD, I noted some folks in the last Zoom poll were highlighted TCFD. So for you and anyone that's used TCFD in the past, you'll also find these standards very familiar. So for that reason, the publishing of the ISSB standards also marked the culmination of the TCFD's work, and the TCFD, if you're not aware yet, has now disbanded. Meanwhile, CDP's climate questionnaire is now aligned with IFRS S2, and the IFRS Foundation has also agreed to take over responsibility for the disclosure-specific materials of the TPT. So as a result, the reporting landscape has been significantly simplified. So we're seeing, I think, less of an alphabet soup, and things are a little easier to navigate. So there's more harmonization and simplification work going on now. And as we continue to develop and publish guidance materials, hopefully things just get easier and more simple. So we have one more Zoom poll for you now that'll pop up on the screen. If you give me 1 second. Here we go. Okay, so companies who disclose using the TCFD recommendations automatically comply with the ISSB standards. True or false? What do you think? Okay, we have about 35 answers. At this point, I really encourage, I think we have around 100 participants. Please do participate in these Zoom polls and the mentees. I think it makes it more engaging all around, and is really helpful to hear your answers and your viewpoints. So please don't hesitate to participate. Okay, so I'll end it there and share the results. So as you can see, about 57%, so a bit of a majority, answered true. That's TCFD recommendations automatically comply with ISSB standards if you disclose, and 43% said false. So the correct answer is false. If you're disclosing using the TCFD, you are well underway towards the ISSB, but there's some more detailed requirements. IFRS S1 also requires the disclosure of all sustainability information, not just climate. So there's a bit more to it than TCFD necessarily offered or detailed. Okay, apologies. Oh, there we go. So now a listing requirement that got a lot of traction in recent years is the TCFD. So many companies are now asking, with the culmination of TCFD, what's next for their TCFD reporting with TCFD disbanding, leaving the monitoring of the progress of companies' climate-related disclosures from TCFD to the IFRS Foundation. Excuse me. So companies should continue to report against the TCFD if they are required to do so until advised differently by the relevant regulator in their jurisdiction. Now, the ISSB standards incorporate the TCFD recommendations and use the same architecture. So any company that has prepared a TCFD report is very well placed to complete additional steps so that they can fully adopt IFRS S1 and IFRS S2. Now, the ISSB is focused on developing the standards that can provide a common language and therefore a global baseline for sustainability information. So it wants to enable comparable and consistent sustainability disclosures across global capital markets. The foundation also works with jurisdictions around the world, as well as other stakeholders, to achieve this. So regulators and stock exchanges are able to require companies to disclose further information by adding their own additional building blocks tailored to those needs. For example, stock exchange guidance on disclosures. Additional disclosures can also be required as long as the information is presented in a way that does not obscure the required disclosures. These building blocks could involve disclosures going beyond the remit of the ISSB standards, such as GRI, or they could include jurisdiction-specific information relevant to investors. And taking this building block approach reduces the need to duplicate information by having that globally consistent baseline of disclosures. So while it still allows you to report additional information based on standards like the GRI standards. So following the launch of the ISSB standards in 2023, the International Organization of Securities Commissions announced its endorsement of the ISSB standards. They asked their 130 members to consider how they can incorporate the ISSB standards into their regulatory frameworks. And now the foundation continues to engage with other stakeholders on adoption and related issues. For example, with the IIASB on a new assurance standard, it will shortly be launched. And as part of its regulatory implementation program, the foundation is also supporting multiple jurisdictions with planning and preparation for voluntary and mandatory adoption. The foundation is also talking to stakeholders around the world who are planning to support voluntary disclosure against the new standards from 2024. With that, I've chatted a lot about the IFRS and their work, but we're fortunate to have an IFRS expert with us here. So I'm going to turn it over to Jarlath to talk a bit more about the business case and market case. So I'll turn it over to you now, Jarlath.
Thanks, Landon. Hello, everyone. Good morning. I'm going to take us through this last unit in this first section, prepare. We've obviously talked about the business case and the market case for sustainability reporting and the evolution of the landscape. So let's start thinking about the two sustainability disclosure standards, S1 and S2. And before we do get into the detail, I just want to stop here for a moment and pause and remind ourselves that there are some key terms that we will use today, and you'll see it in the handout as well if you want to get a little bit more information. But firstly, we'll say the phrase sustainability-related financial information quite a lot. And we simply mean this phrase refers to a broad set of issues that include climate, include nature, biodiversity, social, governance issues. It's not a definitive it's not a definitive term or a defined term. It's anything that fits in that category of sustainability related information. And what we're really interested in is sustainability related financial information, focusing on risks and opportunities that are useful to investors when they are making their own decisions about investing in the company or not. And sustainability related risks and opportunities, we'll come back to this a couple of times today, but essentially there are those risks and opportunities that could reasonably be expected to affect the company's cash flows, its access to finance, or its cost of capital in the short, in the medium, or the long term. And so what we're talking really there about are the company's prospects. And you'll also hear us talk about general purpose financial reports. And this simply it's a generic term that's used to describe a company's financial statements and management commentary. Sometimes it's known as a management report or a management review or a strategic report. So we have this term that covers all of these different names, and that's because they're called different things in different jurisdictions. But you'll see that phrase through the standards. So I noticed a few people are familiar with TCFD, and for those who are familiar with TCFD, you'll recognize the same 4 core pillars or content areas used in the ISSB standards, and they are governance, strategy, risk management, and metrics and targets. Now, if you're not familiar with TCFD, don't worry. It just refers to the architecture. You're not missing out, and we'll take you through all of the detail. So for each of these 4 areas, there's a set of key disclosures that are to be addressed. And the standards provide quite detailed guidance on these individual requirements. And as I said, we'll go through all of this today. And of course, I recommend you download the standards from the IFRS website. So, just as we start here looking at S1 and S2, I might say to anyone with us today who is a preparer, let me begin by saying, don't be afraid. Yes, of course, there is a lot to understand. There's a lot to read. There's a lot to digest. But you might actually be surprised that some of the information here, some of the detail, is already familiar to you. And likewise, for any accountants with us today, you'll also be relieved to see many of the same conceptual foundations which were developed over the last 20 years by the IASB, the Accounting Standards Board, have been reflected in the ISSB standards. So if we start with S1, or to give it its full title, General Requirements, I say that deliberately, general requirements for disclosure of sustainability-related financial information. And S1 sets out these general requirements for the content and the presentation of sustainability-related risks and opportunities. S1 asks preparers also to refer and consider the applicability of the ISSB industry standards or industry metrics and other sources of guidance to identify these sustainability-related risks and opportunities. And the ISSB standards are organized by industry, and that allows the company to identify which are most applicable or appropriate for its business model and its operations. And I know quite a few people indicated they are already familiar with ISSB, the ISSB industry standards. So then moving on to S2. So the scope of S1 is all sustainability topics except for climate. And climate then is covered in S2. Builds on the same foundations of S1, so it incorporates the recommendations of TCFD, it sets out the requirements to disclose material information, and it also requires the disclosure of cross-industry and industry-specific information. Now, in terms of climate-related risks, these include both physical and transition risk, and we'll come back to this a little bit later. One other specific climate-related disclosure includes scenario analysis, and another one is obviously GHG emissions, greenhouse gas emissions. And there's some of the key differences between S1 and S2. And just with S1, preparers are required to consider the applicability of industry-based guidance using S2, and that is organized by industry, allowing companies to identify climate-related disclosure topics and metrics which are applicable to their own business model and operations. Now, as Fiona mentioned already, sometimes we get a question about can I use one standard or the other, and actually they are designed as a package. This is because S1 sets out those general requirements, and that text is not replicated in S2. Some of these general requirements talk about the parameters for the type of information that needs to be provided so that it's decision useful. So, for example, the fair presentation requirement require disclosure of relevant information about sustainability-related risks and opportunities, while the faithful representation requirements talk about preparing a complete and neutral and accurate depiction of those risks and opportunities. S1 also includes the concept of materiality, and all this is it's not replicated in S2. Sometimes the way I try and explain it is, I actually have them here. If you're looking at the standards, I've got a printed copy here, they're each about 45 pages long, and S1 is broad but shallow in terms of depth and content, because it is talking about those general requirements. S2 is also about 45 pages long, but it's narrow in scope because it just talks about climate, but it goes right down into the detail on some of those climate questions. So just referring back to those conceptual foundations for a moment, I mentioned them briefly on the last couple of slides. Now, this will already be familiar to anyone who knows about accounting. Apologies if this is not new for you. But there are a lot of people with a sustainability background who don't necessarily have that insight into the world of accounting. So it's helpful just to pause for a moment and talk about these topics. These conceptual foundations help to understand how best to disclose information in order to meet the requirements of the ISSB standards. So to start with, one of these conceptual foundations is the requirement for a company to fairly present a complete set of sustainability-related risks and opportunities. Fair presentation requires disclosure of relevant information and its faithful representation. So to achieve this, companies need to provide a complete, a neutral, and an accurate depiction of risks and opportunities. And the reporting entity concept in S1 requires the organizational boundary for sustainability risks and opportunities to be the same as for the financial statements. So if you're talking about you're at a group level in your financial statements, you need to also apply the same information for the group in the sustainability related financial information. Another important concept is connected information. And we saw earlier when Fiona explained how the different risks are often connected in that kind of spider diagram. The standards also require companies to clearly identify the key connections. For example, those connections between individual risks and opportunities, the connections between those 4 content areas, and also the connections between the sustainability related financial information in your annual report and the main financial statements in the other part of the report. And I think Fiona is going to take us through an example next.
Sure, thanks, Jarlath. Yes, to bring that concept to life, really, we wanted to share an example from BHP's annual report of how they connect between their company decarbonisation strategy and their financial results. So what do we see here? So we have the decarbonisation strategy with the investment processes and decision making. And in the first paragraph, they talk about how their investment decisions consider the quantity of GHG emissions associated with the project, the cost per tonne of CO2 associated with the project, and the alignment with the group's pathways to a net zero trajectory. We then see that the investment decisions are clearly, connected to the decarbonisation strategy with those specific examples of how they're considering it. And the decarbonisation strategy gives you various types of expenditure now and in the future. So you can see how much they're spending operationally on greenhouse gas emissions reductions in the reporting year, which they highlight as $122 million US. And then what they're anticipating to spend up to 2030. So by that point, they're projecting up to $4 billion US. And so we see here the connection between those projects and the net present value as well. So they base this on assumptions around the achievement of their medium-term targets and how they'll be delivering positive net present value for the group on what they've already done to implement the projects. And we also have a reference at the bottom, a further connection to some information in cross-referencing in other sections of the report that's mentioned at the bottom. So a good example of kind of bringing that connection piece to life.
Thanks, Fiona. Okay, so that brings us on to the 4th poll of the session. So what we're going to do now is test to see who understands the concept of connectivity. So the question is, what information should be considered for connected information? What information should be considered for connected information? And you have 3 options. The first one is governance, strategy, risk management, and metrics and targets. So those 4 content areas. The second option is sustainability related financial disclosures and financial statements in your annual report. And then the third option is sustainability related risks and opportunities. So what information should be considered for connected information? I'll just give it another moment. Okay, I'll share those results. So interesting mix there on the results. In fact, all answers are correct. You should have connectivity, or you should show your connectivity between each of these 3 issues. And don't worry if you didn't get correct, you can have another look at the handout afterwards. Okay. So, on materiality, we already touched on it, and we'll come back to it a little bit later, but I did want to just mention this briefly here. The standards are built on the concept of materiality as defined by the IFRS Foundation, and that definition has been in place for over 20 years with the International Accounting Standards Board, and that definition is replicated then with the ISSB. As I said, we'll come back to this later, but I did want to highlight that when we're talking about material information, we're talking about information that if it was omitted, if it was misstated, or if it was obscured, that it could reasonably be expected to affect investor decision making. Now, we've talked a little bit already about other sources of guidance. When the consultation was happening for the exposure drafts, for the ISSB standards exposure drafts, one of the key feedback topics was the importance of supporting preparers, and particularly those with more limited resources, and as well as those in emerging and developing economies. So in addition to the standards and the application that was guidance that was published in 2023, a number of education resources have also been published then and since, and we're continuing to develop these, including the IFRS Knowledge Hub, and we'll put a link to that in the chat, and we'll talk about it a little bit later on as well. And we're also in the process of gathering examples and some case studies provided by our partners. Everybody wants to see a template or a worked example. And of course, we can't do that because it's not our story to tell. We're not a company preparing the standards. You have to be able to tell your own story in your own way, and that's what the standards allow for. But the case studies we're working on with our partners will help bring some of these topics and these requirements to life based on experience, partly from TCFD implementation and partly from those who are preparing to adopt the ISSB standards at the moment. And I should also note that the Foundation's capacity building program is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, so I'm going to do one last poll here before handing over to Fiona. And the question is, say, for example, you're in a business that water is vital to what you do, but the ISSB standards don't currently have a water-specific standard. So the question is, what do you do? If your business, say your business has a key water dependency, but the standards don't have a specific standard on water, what do you do? And we have 4 options here. The first one is don't disclose anything about water. The second option is consult the sources of guidance that are listed by the ISSB. The third option is engage a consultancy to help. And the fourth option is check what your competitors are doing. So this isn't a multiple choice. You get one choice here. A, B, C, or D. I'll give it another couple of moments. Okay. So this one's a kind of a trick question. 84% said consult the sources of guidance. That's absolutely correct. You should, if the standards don't talk about something that's important to you, then consult the sources of guidance that it points to instead. However, engaging consultancy is also a perfectly valid option if that's if you think that that gives you the answer you're looking for. There's nothing to stop you getting advice from consultants or otherwise. And also, you can check what your competitors are doing. There's no reason for you not to. They might have they might be further down their own disclosure journey. They might have some insight that could help you get your thinking started. So it's no harm to check what others in your sectors are doing as well. And Fiona, I'll pass back to you. Thank you.
Great, thank you, Jarlath, for that. Brilliant. So we'll just close the poll there. Great, so before we wrap up the module, we're just going to summarize a few of the key concepts that we've covered off so far. Great. So firstly, we reviewed the purpose of sustainability related disclosures. And a key takeaway we're hoping that you'll leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability related information. If you're not aiming to make use of the data that you're collecting to improve your own strategic decision making, you're kind of missing a key point here and potentially wasting your own time. So that's a really important thing to remember. If you have operations in hard to abate or high impact sectors, your competitors might be disclosing risks and identifying opportunities that they're pursuing. And that would leave your investors wondering why that you're lagging behind them potentially, which could affect your ability to raise funds and access capital. Then we looked at the evolution of sustainability disclosure standards and the formation of the ISSB and how we simplified the landscape and aim to do that further. And when you're thinking about other voluntary disclosures, you shouldn't see them as competing with the ISSB standards, but rather building on top of them. And finally, we introduced the standards and the important concepts you need to understand in order to use them correctly. And a key point that I want to reiterate here is that these standards and the guidance that come with them are designed to meet the needs of investors. And so they're heavily focused on the prospects that we discussed at the very start of this unit that really focus on connections to financial effects and business risks in that sense and opportunities. So that provides us with a brief summary. And before we finish up this section, we'd like to hear from you again. So what we wanted to reflect on in our next activity is really how will you identify the different skills gaps and knowledge that you need in your organization to start to report against the standards. And so a few ideas on the screen here for things that you could consider. So thinking about the tone from the top, from your leadership team and who's going to be responsible for providing oversight in this area. Integration. So thinking about which teams are already working on topics relating to these risks and opportunities and what capacity building you might need to take into consideration to build integration with those teams. And also potentially negotiating. So do you need to work with your colleagues and your external partners to build more consensus on the need to take action and how that will be done? So perhaps some things to do there. So I'll be sharing screen again with you to the Menti. And if you recall in the chat, we will have the link directly to the Menti, which Landon has reshared. Thank you, Landon. So do feel free to use that direct link. And I have also shared the code in the chat as well, if that's an easier way for you to access. So let's take a quick look. I see we have some responses already coming through here. I'll just minimize that. Which is great to see. So yes, what skills and knowledge gaps might you have and how do you identify those? So we have some responses here already and feel free to keep sharing as we're talking. So we have someone who's highlighted here 3 times that they should audit your current skills, review your training, engage your stakeholders and analyze reports. So doing so, you can develop a targeted training plan, upskilling or hiring. So yeah, that sounds like a really systematic approach there. We have auditing referenced again. And you can also conduct a skills assessment. Yep. Reviewing job descriptions or benchmarking against best practice. More references to training and skills. conducting a skills assessment again. Someone's mentioned a survey here. So yeah, that could be a really good way just to canvass your colleagues and understand who might be able to support you in working on this topic already. Perhaps it's a personal interest, perhaps they have prior experience that could be relevant. So I think that's a really good thing to highlight. Reviewing competencies against the ISSB requirements. I think that's a great structure to use for sure. Benchmarking industry best practices, absolutely. And looking at specific training. So yeah, I know we had some questions earlier in the chat relating to auditor competencies, for example. So yeah, looking at maybe particular professions within your organization and what they might need to know in those capacities is another really helpful idea. So I'm not sure if anyone else has any responses. I'll just give it a second because I know sometimes it can take a moment to catch up. There we go. I see another one come in. So do a capacity mapping across the business and have it mapped across the process map of the organization to canvass who are critical stakeholders in the disclosure process to review reporting. Yes, I think that's a super helpful structure to use. So, you know, using your own organizational structure and thinking about all of those different functions. I think particularly when you're engaging your senior colleagues, I think really demonstrating how it connects to the core of your existing organizational structure and functions and isn't necessarily something new or that should be seen as an add-on to be managed separately is really helpful, because I think we've already established, you know, we're talking about risks, governance, finance strategy here, and data collection and target setting. And those are all, you know, things that organizations will be very much doing already across other topics. So building on that is great. And then here we have engaging a consultant to do a skills gap assessment. Yes, absolutely. I think, you know, maybe getting an external perspective on that skills need could be really helpful to seek some advice if they're, you know, working with other organizations that have that experience. And we also have data management and analysis, which is a topic we will actually be coming on to talk more about later in the session as well. So that's great. I'll leave this question open for a bit longer as well in case anyone wants to share anything further. But yeah, I think that's been super helpful to get your perspective. So thank you very much for giving us your thoughts there. So with that, I will hand back over to Jarlath, who will be taking us through the next segment. Thank you.
Thanks, Fiona. Okay, so module 2. Now we've looked at the initial concepts in S1 and S2. Let's start looking at how to apply the standards, which also takes account of additional disclosures which you might have because of where you're located or because of what sector you're in. We have 2 units here in this module. The first and the main focus will be on applying the standards. And once we cover that, we'll come back to how additional disclosures fit. So let's start with the first one, the governance element or core content area. And the way we've put this together is for each of these content areas, we're going to talk about questions that you could ask yourself or in your own company to start identifying the information that you'll need to support meeting the requirements of the standards. So, for example, as part of a gap analysis, and we heard some other options there in the Menti. So if we look at the governance and management requirement, we can see there's several that are fairly qualitative. So, for example, which bodies are responsible for the oversight and management of processes, of controls, procedures related to managing sustainability-related risks and opportunities. So, for example, is management responsibility for these issues delegated to a specific officer, like a chief sustainability officer, or an individual committee? It could be a risk committee, for example, that fits in under your board or your exco. It's that kind of idea. How and when does that individual or that group get informed about sustainability related risks and opportunities? So is it, for example, is it a monthly update? Is it a quarterly report and so on? How these issues then inform strategy, decision making, and risk management. And this could include setting targets to manage some of these risks. And then finally, whether progress against these targets links to executive remuneration policy. And for more information, you can have a look at the ISSB checklist tool, but remember, it's not a replacement for reading the standards. And we're going to look at a couple of examples to bring this to life and see what we mean in practice. And Fiona is going to take us through these.
Thanks, Jarlath. So our first example here is AIB, which is a retail bank based in Ireland. They have a A rating in CDP and a 30 billion euro climate action fund that they're targeting 70% of their new lending being green by 2030. So quite ambitious targets there. And in this governance model example, we see that they have 3 board committees. They have a risk committee, a sustainable business advisory committee, and an audit committee. And each in turn is supported by an executive subcommittee relating to the same topic, showing that they've kind of got that 3 lines of defense model there in their governance structure. And here they have that clear sort of demarcation between audit, risk, and sustainability, and also think about the split between both financial and the non-financial disclosures in their governance setup. So there are multiple governance models that a company can choose from, however, and it's important that you use a structure within your organization that's not only fit for purpose, but also suits the particular needs of your company. But this is one example of how it could work. And to look at a second example, we have Toyota, the car manufacturer. So it's an early adopter of hybrid electric vehicles, and it's established some, promising environmental credentials compared to perhaps some of its peers. And this example from Toyota's TCFD disclosure illustrates how governance is used to inform risk and strategy. So they speak about the role of the board, what actually the governance mechanisms they have in place have done to inform their long-term environmental strategy. And then in the final paragraph there, we actually see the specific decisions that the board has made relating to the environmental targets, their transition planning, and their investment in battery production. So it's useful as well that we're seeing some specific examples in the disclosure of how that governance model is working in practice. Lovely. So that moves us on from governance then to the next core content area, which is strategy. Strategy has quite a few more disclosures in than governance, but it's really where companies can see the benefits from sustainability related opportunities and indeed start to prepare for the risks as well. So as you can see here, we have 3 high-level areas that we focus on in the strategy content area. That's risks and opportunities, effects, and resilience. And we're going to review each of these separately in turn. So thinking about the IFRS S2 and S1 disclosure requirements on strategy, these are really designed to ensure that users of general purpose financial reports can understand a company's strategy for managing sustainability related risks and opportunities. And if we look at the requirements relating to sustainability risks and opportunities, there are some questions that it will be good to start asking internally. When we're disclosing information about risks, we're required to provide a description of the effects, the time horizons under which these effects are expected, and that can also be important to keep in mind that financial effects could occur before the actual risk or opportunity materializes. For example, if you need to invest in some risk mitigation measures more soon. And indeed, those financial effects can change over time as well. And the last 2 questions on this list particularly look at climate aligning to the requirements of the S2 standard. So, for example, investors may also want to understand what types of risks and opportunities. And we often see that companies using these categories have already identified them through TCFD. So, for example, the physical and transition risk types for TCFD. And both of the S1 and S2 standards provide guidance to companies to identify and disclose risks and opportunities, and recommend, for example, using industry-based guidance and the ISSB standards to support with this. So again, let's see if we can bring that to life for you a little bit with another example. So here we have Goldfields Integrated Annual Report, which is a gold producer with mines in South Africa, Australia, Ghana, Chile, and Peru. And in this extract on the slide, we can see the risks that the company has identified, how they have identified them using a prioritization matrix, and they've actually mapped those risks to their strategic priorities as well, and the particular mitigation policies that they're using for those risks. And if you go through the report here, you can see a lot more detail on this, but this is just an example of how they've presented that view on their particular risks that they're facing from sustainability-related issues. So another aspect that we've mentioned already around risks and opportunities is thinking about the financial effect and thinking about what really needs to be disclosed in terms of time. So you might remember we discussed earlier that time is a factor, and it can be quite different when we're talking about sustainability related disclosures to perhaps other reporting topics. So let's make it clear what we mean by time horizons. In the standards, you're asked to identify within what time horizon any material effects are expected to occur. Definitions of short, medium, and long-term time horizons can vary between companies, and they depend on a number of factors. For example, this could vary depending on the investment and business cycles of your company, the strategic planning horizons, or the life of assets, or even some other factors. So it really does vary here, but what's important is to remember that you do need to define those time horizons for your company, and don't expect there to be a standard definition that your investors will know of in this space. You need to quantify what those time horizons are for your organization in relation to your context and your industry sector. So let's move on now to the second group of disclosures in the strategy category. In the first section, we talked about identifying risks and opportunities that could be expected to affect the company's performance. And then this next set of disclosure requirements focuses on exactly what that effect is and where it occurs in the business. So to start tackling the disclosure requirements of the standards, companies might want to start by asking themselves questions such as describing these effects, understanding the response planned for mitigating or adapting to the effects, and also thinking about how they connect that into their other aspects of risk and opportunity. So let's share another example to give an example of how that looks. So here we have a chemical producer, BASF. The company acknowledges quite explicitly within their strategy that they're affected by climate change, the scarcity of natural resources, pressure on ecosystems, and a growing population. And as we discussed in the first set of questions for strategy, they've actually been able to show which risks and opportunities that they expect will affect them. But what they do here is that they go on to explain those effects in more detail. They say that their business in chemicals and chemistry has a key role to play in addressing those challenges identified through innovation, using raw materials more efficiently, reducing waste, and enabling healthy food production and climate smart mobility. So as well as the changes they hope that the chemical sector will offer society, the company itself is going to obviously have to undergo some profound changes. And these transformations all along the value chain are shown in the excerpts that we see here, where we can see that the company's supply chain, its production, and its products are all referenced as things that will be affected and need to be considered in the context of these risks and opportunities. Great. So sometimes one of the obstacles that companies face when they're reporting on these effects is what sort of detail should be disclosed. And in the example we just looked at, we were showing mostly qualitative disclosures and descriptions. But of course, quantitative information is important here. Companies needed to disclose both quantitative and qualitative information about those anticipated financial effects and the current ones as well. However, the standards also set out criteria for when only qualitative information may be required. So using only qualitative information for current and anticipated financial effects is permitted for a number of reasons. So if a company cannot separate the effects of a climate-related risk or opportunity from other effects, or also if there is a high level of measurement uncertainty. And additionally, only qualitative information is required for anticipated financial effects if the company doesn't have the skills, capabilities, or resources to provide that quantitative information. So although, of course, a quantification is very helpful where it can be provided, there are obviously a number of cases recognized here where qualitative information may be all that can be provided, and that's understandable for those reasons. So then coming to the last strategy component, which is looking at resilience. So the first part, we talked about risks and opportunities. The second part, what the effects of those risks and opportunities are. And now we're really thinking about how the company is prepared for those uncertainties and ensuring its resilience for the future. And this really gets into the practices and processes that the company needs to have in place to assess its resilience and to make strategic adjustments where needed. So disclosures can include information on what types of assessment have been used and how scenario analysis might have been considered. So at the heart of this, resilience disclosure requirements are asking companies to think about the assessment of climate resilience in particular, and the inputs and key assumptions that have been used in this analysis. So we'll go deeper into scenario analysis in a moment, but some of the key questions that you might want to ask internally when you're starting out here are thinking about the company's capacity to react or adjust to those uncertainties. So, what steps could you take? How ready would you be to take those steps if you needed to? And also, what scenarios have you considered? Are you thinking about those different pathways for how the future may unfold and what those might mean for your business? So again, let's look at a couple of examples here to bring some color to this. So here we start with Stora Enso, a Finnish and Swedish forests product company. And here they have a small diagram you can see on the top right of the screen there, which shows what they're projecting their sales may look like in 2030. And they distinguish between both their essential and their growth businesses in this infographic. We don't have any numbers here, but we do have an immediate picture of where growth is anticipated, and also describe about the company's long-term vision and their recent transition. And here they reference that they have been proactively repositioning the business from largely a pulp and paper company to a renewable materials company, ensuring their future for years to come. So this really gives a sense of how they're thinking about those long-term resource scarcity and decarbonisation challenges that they face, and thinking about how they can really pivot strategically in the long term to address that. And a second example is from Solvay, which is a Belgian chemicals company. And we're using this example to really illustrate some financial effects. And here we want to highlight that they're being transparent about those estimates that they're making and the notes that they provide on their scenario analysis. So if you're using scenario analysis as a tool, investors really need to understand how you've actually used it, not just that you have done. So here you can see in this excerpt that they talk about what assumptions they have used in their scenario analysis, looking at the tool that they've used with a particular consulting firm to identify those assumptions. And then they also talk about the internal experts that they've drawn upon to work with this consultant to conduct the assessment. So I think that can be very helpful to provide that level of transparency. We should say we appreciate some of these examples will be quite small, so do please take time to review them in the handout materials available on our webpage. And of course, you can look at the wider reporting of that company in the link to the reports at the top of the screen. Great. So with that, I think we will move to another Zoom poll now, which should be coming up on your screen momentarily. So the question that we're asking you on this occasion is you may choose to, checking which is correct here. So a company may choose to disclose only qualitative information and or combined quantitative information about current and anticipated financial effects when, and here you can select more than one which you think would apply. So they can disclose either qualitative or quantitative when they cannot separate the effects of a climate-related risk or opportunity from other effects, when there is a high level of measurement uncertainty, or when the quantitative information sheds a negative light on the company. So I'll just give you all a second to review those options and provide your response. So let us know which of those you think is a correct circumstance where you can use qualitative information as well as quantitative. Great, I see we're up to about 30% participation. So I'll just give you another moment. It's always really helpful for everyone to share and let us know what you think. So I see a few more responses coming through. Okay, we will close off there. We're getting up towards halfway. So I will share those results with you now. So we'll see that the majority of you selected the two top answers, which are the company cannot separate its effects from other, cannot separate the climate effects from other effects, and that there's a high level of uncertainty. And indeed, those are the two correct options. So those are both valid cases for providing qualitative information or a combination of qualitative and quantitative. But of course, the third answer would not be correct. So we can't choose not to disclose information because it positions the company negatively. It's really important that we're providing balanced information to our investors on those risks and opportunities. So yeah, that is incorrect. So thanks everyone for those responses. So we'll stop sharing there. And I will be handing over to Landon now, who'll be looking at the next segment for us. Thank you, Landon.
Great, thanks, Fiona. So continuing the conversation, so the governance requirements in S1 and S2 are very similar without specific additional requirements for climate. However, when we're disclosing information relating to strategy, there are additional requirements in S2 regarding climate. So let's take a quick look at those. So as we introduced earlier in the previous module, the disclosure requirements in IFRS S2 are broadly consistent with TCFD, except in certain instances. For strategy, some of those include that IFRS S2 additionally requires a company to refer to and consider the applicability of industry-based disclosure topics in the industry-based guidance in identifying climate-related risks and opportunities. IFRS S2 also requires disclosure of more detailed information around where in the company's business model and value chain risks and opportunities are concentrated. In describing the effects of climate-related risks and opportunities, IFRS S2 also requires more detailed information. For example, when disclosing how a company has responded to and plans to respond to the identified risks and opportunities, the company is required to disclose any transition plans it has and how the company plans to achieve its climate-related targets. Also, in providing disclosures about the current and anticipated effects of the risks and opportunities on a company's financial position, financial performance, and cash flows, IFRS S2 sets out criteria for when quantitative and qualitative information is required. Disclosure of only qualitative information is permitted under some circumstances. For example, when a company cannot separately identify the effects of the risk or opportunity, or when the level of measurement uncertainty involved is too high. When preparing disclosures on the anticipated financial effects, IFRS S2 requires a company to use all reasonable and supportable information that's available at the reporting date without undue cost or effort, and requires the use of an approach that's commensurate with the company's circumstances. So in using climate-related scenario analysis, IFRS S2 requires the use of an approach that is commensurate with the company's circumstances and a consideration of the reportable and supportable information available without the undue cost or effort. So IFRS S2 doesn't specify the particular scenarios that a company would be required to use in its climate-related scenario analysis, and IFRS S2 does require additional information regarding resiliency on significant areas of uncertainty considered by the company in its assessment, and a company's capacity to adjust and adapt its strategy and business model over time. And lastly, details on how and when the climate-related scenario analysis was carried out. IFRS S2 also requires you to disclose any climate-related transition plans you may have, but there's no ISSB requirement to prepare one. Let's briefly review what transition plans are and the work SSE is undertaking to support them. So transition plans are an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a net zero economy, including, for example, GHG emissions reductions plans. As an aspect of the company's overall strategy, bear in mind that the transition plan must be aligned with that strategy, including the business case and motivation for transition and the levers that the company's strategy is most suited to using for decarbonization efforts. This transition plan should also be aligned with science, including what science says about requirements for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained in terms of the science. The plan must also include long-term transition goals supported by activities and targets to achieve those goals, as well as interim targets to monitor progress. So given the uncertainty surrounding the transition, the plan should be transparent about how the dependencies for plan progress or success, as well as the risks and challenges of implementing the plan, and how residual or unabated GHG emissions will be handled. The transition plan will proceed in different ways for different sectors. Therefore, sector-specific pathways should inform the development of the company's transition plan, and we're going to look at some of the resources available for this in just a moment. Finally, companies should consider how the transition plan will be evaluated by investors and others, and ensure that the plan has the hallmarks of credibility. So to get started on transition plans, there's many resources that you may want to start looking at. And for more details on how to get started with transition plans, you can use our SSE training tool on transition plans. We'll share the link to that in the chat, and you can also find it on the SSE website under the Publications tab. GFANZ, the Glasgow Financial Alliance for Net Zero, set out the expectations that companies can use to develop their own pathways, and the Transition Plan Task Force Disclosure Framework provides additional guidance alongside ISSB on the disclosure of transition pathways. For awareness, it was launched in the UK in 2022 to bring together leaders from industry, academy, and regulators to develop good practice for transition plans, disclosures for finance and real economy companies. I will just note that the IFRS Foundation has assumed responsibility for the disclosure-specific materials developed by the Transition Plan Task Force, and these will be updated in due course. So, as I said, there's a lot of resources, a lot of great resources on transition plans, so highly encourage you to check those out. Now, we know this is a lot of information in one session, so we're going to give you a short break, a 5-minute break. And at this point, if there's any questions you'd like to ask, I will just remind folks to use the Q&A box, and we'll make sure to address those as quickly and as well as we can. So when the music stops playing for the break, please return but hopefully you can grab a coffee or stretch your legs. We'll see you again soon. Okay, welcome back, everyone. We'll get started again. Hopefully you had some time to stretch your legs or grab a cup of tea. Okay, so now let's move on to the next core content area of risk management. So as you can see at the high level here, this category of disclosures requires report preparers to disclose information on their processes for risk management, for sustainability related risks and opportunities, as well for how those fit within their overall risk profile. So let's dig a bit deeper into this category. And as a reminder, in the strategy content area, we're also talking about sustainability related risks and opportunities with a focus on the risks and opportunities that could be reasonably expected to affect a company's prospects. In the risk management disclosures, the focus now turns to how exactly a company identifies those risks, such as material risks, and assesses different risks and opportunities more broadly. So a company is required to disclose information about the processes and related policies for risk management. So a firm might need to start asking some questions internally about inputs and parameters for risk management, whether and how sustainability related risks and opportunities are prioritized, how the nature, likelihood, and magnitude of risks and opportunities are assessed, how sustainability related risks and opportunities are monitored, and whether and how processes have changed since the last reporting period. Beyond these, the standards also ask about the extent to which and how all of this has been integrated into the company's overall risk management process. So as with strategy, there's certain considerations in S2 that build on what S1 requires for risk management. For example, you'll have to provide more details on the inputs that are used to identify and assess risks, on scenario analysis used, and on any changes to the risk management processes. S2 also requires more details on opportunities, as these aren't discussed in TCFD to the same extent. And part of identifying risks is being aware of what risks and opportunities you should be evaluating to begin with. TCFD specified types of climate-related risks and opportunities, as well as examples of the financial effects they might lead to, for example, transition risks and physical risks. Now let's talk about those two types of risk. Sorry, mixed up the slides here. Okay, there we go. So, as mentioned, there's these two buckets of risks. So transition risks arise from efforts to transition to a lower carbon economy and are often categorized as policy and legal, technological, market, and reputational risks. So these risks could carry financial implications for a company, such as increased operating costs or even asset impairment due to climate-related regulations. The company's financial performance could also be affected by shifting consumer demands and the development and deployment of new tech. Now, physical risks can include risks from climate change that can be event-driven or acute physical risk, or from longer-term shifts in climate patterns, chronic physical risk. So acute physical risks arise from weather-related events such as storms, floods, droughts, heat waves, which, as we know, are increasing in severity and frequency. Chronic physical risks arise from longer-term shifts in climatic patterns, including changes in precipitation and temperature, which can lead to sea level rise, reduced water availability, biodiversity loss, and changes in soil productivity. These risks could all carry financial implications for a company, such as costs resulting from direct damage to assets or indirect effects of supply chain disruption. The company's financial performance could also be affected by changes to resource availability, extreme temperature changes, and employee health and safety. So On the other hand, there are also climate-related opportunities which refer to the potential positive effects arising from climate change for a company. For example, efforts to mitigate and adapt to climate change can produce climate-related opportunities such as innovation in your operations, improving your processes, resource efficiency, use of lower emission sources of energy, and supportive policy incentives, to name a few. If your company identified and disclosed a risk or opportunity, it might benefit from a first mover advantage. An investor could look at your sector, see your disclosure, and wonder why your competitors have not identified or sought to mitigate that risk or capitalize on the same opportunity like you have. This could have positive financial and reputational effects for that company. Now I'll turn it over to Jarlath at this point for an example.
Thanks, Landon. So, NATS is the UK air navigation service provider. It handles UK domestic and North Atlantic air traffic control. Many of us will know how bad weather already causes delays for airlines and airports and yourselves, obviously, as passengers. And this can often lead to increased CO2 emissions due to aircraft circling in holes, or even, if you're quite unlucky, being diverted as airspace becomes congested and inefficient. We know climate change is driving increased frequency and severity of bad weather events, for example, summer thunderstorms and even turbulence, while on the ground, extreme temperatures, flooding and winter storms all affect airports and network infrastructure. However, longer-term changes in the climate pattern may influence the jet stream, and that could shorten times for some intercontinental journeys. The example here provides important details on how this particular risk was assessed and how it was deemed to be material for NATS's stakeholders. Building physical and operational resilience will need to be addressed in its strategy and in its long-term investment plans. Okay, so now we're going to spend some time reviewing the disclosure requirements on metrics and targets, and this is the last of the 4 content areas. Let's start with metrics. Requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. Preparers need to disclose information explaining how metrics are defined, if they're absolute or relative, if they're being validated by a third party, as well as the methodology. So, for example, what was the method of calculation? What were the inputs? Are there any limitations involved? What kind of assumptions do these depend on? Then moving on to targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its own strategic goals. So, for example, disclosures could include whether they're qualitative or quantitative, and whether they've been set voluntarily, or in some cases they have to be set by law or regulation in some jurisdictions. As well, the disclosures require information on the metric which is being used to set the target, and also that's used to monitor progress towards achieving that target. You'd expect to see naturally the baseline period from where progress is measured, as well as an endpoint. What's the target year, for example? We know many companies are setting long-term greenhouse gas emissions targets out to 2050. And in that case, sometimes you'll see interim targets or milestones along the way, and they should be disclosed. And of course, if there's been any changes, any revisions to the target, you want to see that and a justification or an explanation for those changes. I'm going to pass over to Fiona now for an example.
Thanks, Charlotte. So the next example we have is ArcelorMittal, which is a multinational steel manufacturing and mining company headquartered in Luxembourg, but operating globally. So this is from their 2022 annual report, and we see here regarding their decarbonisation approach, we have their ambition. So they set out an ambition to be a leader in the steel industry and achieve net zero steel making by 2050 globally. They then set out their targets to achieve this. So they have a particular target to reduce their intensity by 25% globally and 35% in Europe in particular by 2030. And then they talk about the emission scopes that are covered by this target and their roadmap to achieve that with particular actions in 2021. They do also disclose the particular investment they're putting behind this strategy of $10 billion, and also disclose some of the dependencies that they're reliant on for success. So, for example, the policies that need to be implemented and the regulatory frameworks that they will rely upon to deliver this plan. So all of this is also complemented within the report itself with a waterfall chart, which shows kind of the expected plan from 2030 out to 2050 as well. So I'd recommend looking at that if you look in the handout and follow the link there.
Thanks, Fiona. And there's another example as well in the handout you can take a look at. So let's now talk about some of the climate-specific considerations for disclosures on metrics and targets. Recognizing not everyone has done TCFD joining us today, so we might just zoom through this part. But for those of you who are familiar with TCFD, who are using it and who are thinking about what a transition looks like, these slides are particularly relevant for you. The TCFD framework included recommended disclosures, 11 of them, and the IFRS standards build on and add to a number of these. So, for example, IFRS S2 requires disclosure of industry-based metrics, which are relevant to a company's business model and activities. In addition, additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and any joint ventures, as well as information about the company's financed emissions. S2 also sets out a Scope 3 measurement framework, which tries to help provide guidance for preparers looking at Scope 3. And while S2 does not explicitly require a company to disaggregate its emissions by the individual constituent gases, S1 does have a requirement on disaggregation. So if the disclosure of those constituent gases would provide material information, then it should be disclosed. But otherwise, it's not necessary. And of course, as a little reminder, there's more information on climate metrics in the SSE training tool on the topic, and we'll share a link to that in the chat. And you can also find it, of course, on the website. And as well, as you can see on the bottom of the slide there, we have the IFRS Foundation has published guidance on this topic as well. Likewise, there's additional guidance. There's additional disclosures compared to TCFD on targets. So, for example, S2 requires disclosures about how the latest international agreement on climate change has informed your target and whether the target has been validated by a third party. S2 also requires disclosure of more detailed information on greenhouse gas emission targets, including additional information about any planned use of carbon credits to achieve your company's net emissions target. And S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how you monitor progress against any target that you have, including whether the greenhouse gas emissions target was derived using a sectoral decarbonisation approach. Moving on then to emission metrics. Now, we get questions on this fairly frequently. A lot of people do understand this, but it's helpful maybe just as a little reminder for anyone who's not familiar, or as a reminder and for the benefit of anyone who's not familiar. When we talk about greenhouse gas emissions, we use a certain terminology, which might sound a little strange, but the language is what it is. Scope 1 refers to all direct emissions that occur from sources owned or controlled by your company. And that would include emissions, for example, from your company's own facilities or vehicles. Scope 2 then refers to emissions from the generation of acquired and consumed electricity, plus steam, heat, and cooling. And for most people, or most companies, this is simply electricity that you purchase. And then scope 3 is essentially everything else, all other indirect emissions that occur in your value chain, upstream and downstream. Now, S2 requires a company to disclose its absolute gross scope 1, scope 2, and scope 3 emissions using the GHG protocol, unless your jurisdiction requires you to do something different. And if you are using a different methodology or measurement approach, you have a transition relief to continue using that approach in the first year of applying the standard. It also asks for whether and how your company is using an internal price on carbon for decision making, and whether and how executive remuneration is linked to climate change. And we mentioned this a little while ago as well. And Fiona is going to take us through an example next.
Thanks, Charlotte. So to show what this can look like for a real company, we have an example here from Enel, which is an Italian electricity and gas company. So this example shows one of the ways that Enel disaggregates and explains their greenhouse gas emissions. But within their sustainability report, they actually have a number of different disclosures on this. So again, worth looking at the report to see the full disclosure, but here's a few excerpts that show some of the key information. So at the top, we have the company's carbon footprint broken into those scopes of 1, 2, and 3, as we talked about. And they've provided a comparative analysis between 2 reporting years of their emissions under each of those scopes. Then on the second bottom half of the page here, we have a breakout of their scope 1 emissions between their different business activities. So obviously, as an energy company, their direct scope 1 emissions are relatively quite large, and here they particularly show obviously that generating electricity using thermal power generation, so combustion of natural gas and other fossil fuels, is obviously one of the most substantive contributors to their scope 1 emissions and their overall footprint. And they have some numbers that footnote in the disclosure that also show you what types of greenhouse gas these emissions relate to. So in particular, of course, they have carbon dioxide emissions, but actually, again, because of that thermal power combustion, there's also methane and nitrous oxide as well. Getting into the detail a little bit, but within the greenhouse gas protocol, you'll be required to report all of those types of gas and to aggregate them as carbon dioxide equivalent. So obviously they've provided transparency on those different types of gas that make up their overall footprint as well. And then we also have some little dots that you can see next to the different emission sources, which show you whether or not it's covered within their Science-Based Targets Initiative decarbonisation targets. So you'll see here that they're actually managing to convey quite a lot of different information about their emissions and their target setting within this diagram. So it's quite useful to consider as an example of how you can get across quite a lot visually on this topic. Great. So with that, we will move into another Zoom poll, which should be popping up for you shortly. And so the question we'd like to ask you is, what is the objective of metrics? Is it to enable report users to understand performance in relation to the entity's sustainability-related risks and opportunities, to understand progress towards any targets, or to understand the company's assumptions for the future? And this is a multiple choice one, so please select as many of those as you think are correct. So I'll just give you a moment to respond to that. See, we have some responses coming in, so that's great. Just give that a second and see if we can make it up to the halfway point. I know we've been talking at you lots, so it's jumping into thinking mode, which hopefully is helpful to re-engage. Okay, we seem to be bottoming out there, so I will end the poll and share the results with you. So yeah, the most of you had this correct. It's the top two answers there, which are the correct answers relating to the objectives of metrics. So helping to see performance and to see progress against targets. Because I think, you know, although this does give some insight into the company's assumptions, it doesn't necessarily give you as much of a forward-looking perspective, because metrics obviously are predominantly backward-looking, relating to what has already been happening in the previous reporting years. So actually, if we want to think more about the future assumptions, that's where we would really be looking to the resilience requirements that we discussed earlier regarding scenario analysis. So that's the sort of rationale for that one. Okay, brilliant. So I'll stop sharing that one and we'll move on to Landon for the next segment.
Great, thanks, Fiona. So with that, we've now covered all of the core content of disclosures that meet the ISSB standards. However, as all of you are aware, as all of you are aware, there are often also regulatory requirements and other additional disclosures that companies need to consider. This final section of the Align unit will cover this briefly. So many companies already disclose against voluntary and mandatory reporting standards based on their jurisdiction, stock exchange regulations, and industry norms. These things include topics or elements such as local requirements. So both listed and non-listed companies must understand and comply with jurisdiction-specific disclosure requirements. Companies in your supply chains should also be prepared to provide the necessary information upon request. There's also policy objectives. So companies should familiarize themselves with policy objectives aimed at promoting sustainability. So governments may offer incentives like tax cuts, grants, subsidies for sustainable practices. They may also implement disincentives for activities counter to national objectives. Companies may also need to provide additional disclosures to align with emerging industry practices and effectively manage sustainability-related risks and opportunities depending on their sector. And companies should also identify other stakeholders and their requirements through materiality assessments to ensure comprehensive disclosure practices. So you can expect your national regulator to consider how the ISSB standards sit alongside pre-existing disclosure requirements, and this may involve a public consultation. So more than 20 jurisdictions have already decided to use or are taking steps to introduce ISSB standards in their legal or regulatory frameworks. And together, these jurisdictions account for around 55% of global GDP, 40% of global market capitalization, or 75% excluding the US market, and 50% of global GHG emissions, or more than 50% actually. So there's more information about the regulatory implementation program on the IFRS website, which we've linked prior. So on voluntary reporting standards, the IFRS is actively supporting jurisdictions and non-jurisdictional stakeholders to ensure that the ISSB global baseline meets investors' needs and has good interoperability, reducing duplication and improving efficiency of the reporting system. So many of the decisions taken to develop the ISSB standards have helped advance interoperability. For example, using the TCFD architecture as the basis for our standards facilitates interoperability with existing disclosure requirements. CDP is ISSB's key global climate disclosure partner, and the 2024 CDP questionnaire is aligned with IFRS S2. And in addition, the IFRS Foundation is working closely with the GHG protocol, GRI, and others on these issues. So on ISSB and GRI, IFRS and GRI are looking at ensuring the maximum interoperability between their standards, again, to facilitate efficient and effective reporting by companies around the world. We can drop in the chat recent mapping and information on the Sustainability Innovation Lab if we haven't yet. And then IFRS and EFRAG or EFRAG have also been working closely to support interoperability between the ISSB standards and the European Sustainability Reporting Standards, ESRS. For example, this included mapping each IFRS S2 paragraph to relevant ESRS paragraphs. So many companies are expected to choose or be required to apply both ESRS and ISSB standards. So as jurisdictions around the world introduce the standards as a global baseline, companies will be better prepared to meet disclosure requirements around the world. The high degree of alignment between the standards and ESRS reduces complexity and duplication for companies applying both. ISSB standards facilitate decision-useful information targeted at capital markets, enabling global comparison for investors. As well, should mention that joint guidance published by IFRS and EFRAG provides practical support that explains how companies can efficiently comply with both sets of standards. So there is guidance out there to help folks and help companies on that element. So next, the integrated reporting framework. This provides principles-based guidelines or guidance, I should say, for reporting structure and content. So when used together with ISSB standards, including the sources of guidance, the integrated reporting framework can support a holistic view of the value creation process through governance and business model disclosure to drive connectivity between financial statements and sustainability-related disclosures. As such, it supports high-quality corporate reporting, and when it is underpinned by integrated thinking, it can enhance the quality of a company's corporate governance. So to wrap up this part, or before we get to the end of the module, we have a final for this module Zoom poll. So what should your disclosure objectives consider? A, the ISSB standards only, B, the ISSB standards and regulatory requirements, C, just regulatory requirements, or D, ISSB standards, regulatory requirements, and other sources of guidance. So we have about 40 people who have answered. Let's see if we can get a few more answers before we close the poll. Okay, see the poll slowing down. So we'll end it there and I'll share the results. So a few folks answered just the ISSB standards. Some more participants answered B, standards and regulatory requirements. But the correct answer is D, the ISSB standards, regulatory requirements, and other sources of guidance is what you should consider for your disclosure objectives. So most folks got that one, so well done on that. And I'll turn it over now to Fiona to summarize this module.
Great, thank you, Landon. Brilliant. So as Landon mentioned, we're going to wrap up this module here. And after I give a little bit of an overview here, we'll be jumping back into Menti. So I've reshared the link in the chat, and do feel free to get your your brain flowing if you're already thinking of any ideas there. But, oh, excuse me, I'll just go back a slide. But before we do, I'll just remind us what we have learnt so far in this module. So we've reviewed all of the 4 content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. But an important thing to remember is that these don't operate in silos. We saw in those examples that despite having 4 separate categories of disclosure, all of this information is interconnected. We also talked about how your disclosure might go beyond the requirements of S1 and S2. So, for example, to meet the needs of different stakeholders, to meet regulatory requirements in certain jurisdictions, or perhaps to meet industry standards. And what's important to remember when doing this is that the ISSB standards have been purposely developed to act as a baseline. And the building blocks approach allows report preparers to add additional disclosures on top. But in doing so, we would just advise you to be careful not to obscure the requirements of S1 and S2. Lovely. So we will now move into our next activity to end up this Align module. So what we'd like you to think about here is to identify where you are now and what tools really you could use to identify the gaps in your disclosure. So this is really around conducting a gap analysis to think about where you are and thinking about maybe how you go about identifying what the particular areas are in your reporting that you need to potentially tweak. So I shared the link to this in the chat, and then I will just share screens again with you all now so we can see the answers coming in together. Great. So I see a few responses coming through, which is great to see. So someone here has highlighted conducting a gap analysis, using a framework, perhaps getting internal audit to review things, and getting stakeholder feedback, benchmarking, and using software. That sounds like a really comprehensive approach to me, you know, considering both those external sources and your internal sources that can support you in doing this. Oh, I have an interesting answer here relating to permaculture, whole systems design, holistic management. Yeah, that's really interesting, and obviously in that sector is potentially quite a relevant issue to consider. So we have also materiality assessments, exactly like if you have already looked at materiality as part of existing use of frameworks, you'll have a good starting point to consider those sustainability risks and opportunities. Using data and software to identify gaps. Yeah, I think that can help quite a lot with the structure. Surveys for the management, indeed. Yeah, so maybe actually asking your leadership and management teams what are their perceptions on the gaps. I think that could be a very helpful starting point to help you to target your thinking. And we'll just give it a second to see if anyone else would like to share their response. Do feel free to keep posting. Sometimes I know Menti can take a second to update, so I'll just wait a moment in case anyone else is in the process of typing. Okay, don't see any more responses coming through at the moment, so we'll leave that there, but thank you for sharing, and I'll leave this one open for a little longer if anyone would like to add anything further as they think through it. We should say as well that these exercises are aligned to your homework contents. So yeah, of course, you'll be able to continue to build out your thinking. I think you highlighted some really good answers there, but a few other things that we might mention in this area would be, of course, those training and gap analysis tools from the SSE that we mentioned already. The guidance on the S1 and S2 standards, of course, and then the different sets of mapping that have been undertaken between the different frameworks. So that can really help you to see, perhaps if you're using some of the frameworks already, but need to understand the gaps relative to S1 and S2, you know, a structured mapping is available. So we've shared some links to those already, and further links will be available in the downloadable resources for you as well. And then the final thing, as I know a few of you are already using TCFD to mention, is that actually if you're reporting on TCFD already, that structure of those 4 core content areas is, of course, part of the TCFD. So you will have a good starting point there to benchmark and to build your approach from as you expand out to other sustainability topics. Lovely. So that brings us to the end of this module, and I'll hand over to Landon, who'll be moving us on to the next segment.
Great. So now that we've outlined the detailed content required for disclosure, let's look a bit more practically at how that's done, starting with the practices and processes needed to collect the appropriate data for disclosure. With that, in this unit, we're going to cover 3 topics that are key to collecting sustainability-related information or data. And as I mentioned, this unit will cover in more detail the how aspect. To kick us off with the unit, let's first look at how to identify sustainability-related risks and opportunities. So IFRS S1 asks companies to provide material information on all sustainability-related risks and opportunities that could reasonably be expected to affect a company's prospects. IFRS S2 sets out the requirements for climate-related disclosures. So what about risks and opportunities beyond climate? S1 directs companies to sources of guidance to support the identification of risks and opportunities and information to disclose about other risks and opportunities. First, when identifying which sustainability-related risks and opportunities to report on beyond climate S1, S1 says that consideration must be given to the SASB standards. In addition, companies may consider other materials, including industry practice and materials of other investor-focused standard setters. Then, after a company has identified which sustainability-related risks and opportunities to provide information about, S1 supports companies in identifying what information to disclose. Here, S1 says again, a company must consider the SASB standards. In addition, a company may consider other sources, including the GRI standards and the European Sustainability Reporting Standards. With that, I want to talk through an example with everyone. So Yara is an international global crop nutrition company. We have Yara's report here. It provides an example of linking megatrends such as population growth and geopolitical and trade uncertainties to sustainability-related risks and opportunities. For example, Yara notes that the climate crisis is set to put food systems under extreme pressure, affecting agricultural production globally. There's increasing expectations for and regulations related to tangible climate actions and the reduction of greenhouse gas emissions. So Yara then translates these risks, including, for example, regulatory changes, consumer demand for sustainability, and optimized fertilizer use, which can lead to lower fertilizer demand growth, environmental costs and taxes, which can increase costs, physical climate change risks to their operations and customers, amongst others. Yara also shows the opportunities, which include a few such as digital tools to enable new market channels and reduce the yield gap through farmer connectivity, mainstream adoption of clean ammonia and hydrogen, a focus on soil health, water use, biodiversity, where optimal fertilizer use has a positive impact, and new monetization opportunities from increased data access. We have one more example here with Neste. So this is an extract from Neste's 2023 annual report. They're based in Finland, and they're the leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. They use science and tech to transform waste and other resources into those renewable fuels and circular raw materials. The company aim is to help consumers reduce their GHG emissions through the use of their fuels and products, which they call their carbon footprint, i.e. offering solutions and opportunities to their customers. They also aim to reduce their own carbon emissions or their footprint and reach carbon neutral production by 2035. The extract you see on your screen comes from the climate section of the company's annual report. It shows how the company identifies both risks and opportunities using 3 different temperature scenarios, 1.5 degrees, 2 degrees, and 2.5 to 3 degrees. And over time, they use a time horizon until 2050. So the extract shows an overall assessment of whether the scenario is positive or otherwise for the company and the indicative financial effect. Because of their business model, they focus on development of renewable fuels and circular products. They see the greatest opportunities arising in the lowest temperature scenario, but this depends on rapid and radical temperature reductions. Despite everything, identifying risks and opportunities can be a challenging exercise, but it is absolutely valuable. So to make sure that the effort is proportional to the benefit, the ISSB standards specify that in applying specific requirements, companies shall use all information that is available at the reporting date without undue cost or effort to disclose sustainability-related financial information. At the same time, companies are required to use all reasonable and supportable information when assessing and disclosing risks and opportunities. This means that the company uses for assessing its risks and opportunities shall be specific to the company. This is important to understand impacts on the actual company rather than in general. And at the same time, the company should understand how it might be impacted by external factors. In some cases, reasonable and supportable information includes information about past events, current conditions, and forecasts. These can help identify trends and potential developments that the company should prepare for. Furthermore, the ISSB standards also require preparers to use an approach that's commensurate with skills, capabilities, and resources when they're applying certain requirements. With that, I'll turn it back over to Fiona.
Thanks, Landon. So great. This is just a quick reminder on where we are in the content for this module. So we've covered identify there, and now we're moving on to evaluating. So we've identified risks and opportunities, and then of course we talked about financial effects earlier, and this stage is where that element really needs to be evaluated. And I think this is an aspect that can be particularly daunting when first getting started. So here we're going to cover off a few of the key concepts that can help you in this process. So to help investors understand a company's resilience to climate risk, the S2 standard requires a company to disclose information about the impacts of climate change on its strategy and business model. And it also asks the company for its company's financial and operational capacity to adjust or adapt over time. And that can be those short, medium, and long-term time horizons we spoke about earlier. So for example, you might test your company's resilience against a new regulation to limit certain high emissions activities, or your company's ability to respond to changing crop yields due to more frequent heat waves. And to do this, you're going to need to use scenarios that are based on climate science and analyze how these scenarios will lead to the company's effects on financial position and performance. And it's important to remember scenario analysis doesn't need you to predict the future. It's a tool to test resilience against potential plausible future effects. So not about predictions, but just about projections and forecasting to understand what might be possible. So S2 doesn't specify which particular scenarios a company should use in its analysis, but it asks the company to make sure that they're using relevant scenarios that provide good information and that it is clear about the rationale for why it's selected the scenarios it's using. It also asks the company to provide information about the assumptions that it's used in its scenario analysis. And within S2, there's guidance on a company how they can determine their approach to scenario analysis, which covers a range of practices from getting started with perhaps qualitative scenario narratives and then moving increasingly towards more quantitative and statistical modeling methods over time. So considering this, the ISSB standards overall require companies to use an approach that's commensurate with their circumstances, and to use all reasonable and supportable information that's available to the company at the reporting date. Again, crucially, without undue cost or effort, recognizing, of course, that scenario analysis is something that will take a time to build up towards increasing maturity in. So we'll use some examples again here to zone in a little bit further on how this actually comes across in disclosures. So here we have Cemex, which is a Mexican buildings materials company, which works in over 50 countries. So here Cemex have used a scenario analysis and they've reported the results within their public reporting. And this really illustrates how they've combined the analysis with their assessment of progress against stated policies, the SDG commitments, and net zero targets. So thinking about those three different scenarios, which I believe draw from the IEA, or International Energy Agency. So the table here describes the risks in the top half, and in the bottom half, we see opportunities. They also have a table further in their report on the page before this one, which outlines the detail of these three scenarios we see referenced here. And it gives you the sources of those scenarios, the expected temperature range that would be seen under those scenarios, and some of the key assumptions that underlie the narrative for each scenario. So it's important to remember that actually it's important to show your investors how you're using these scenarios and how you've developed that thinking. And what's interesting overall in this disclosure example is that they've identified different scenarios that opportunities for their business actually outweigh the risks here, which is an interesting thing to see. So it's really important to make sure that all the commitments, policies, etc., that you have align with this, so that we can clearly see that the SDG alignment, net zero target, and risk management are all working together and not against each other, and don't duplicate practices. Great. So next, we'll cover a little bit about anticipating the materiality of future events, which of course can be particularly challenging as we're projecting into the future. So to help with this determination, the IFRS S1 standard asks you to consider a number of issues to help you with this determination. And you can think of this list as identifying all the steps and information needed to come to your judgment. For example, companies should be considering all low probability but high impact events. So those kind of more black swan issues, which ultimately, if they were to occur, could have very significant outcomes. And any uncertainty relating to the company's future cash flows should also be evaluated, as another example. An important point to note here is that this is something that will need to be reassessed at the start of every reporting period. So obviously there's a lot of variables that underlie these considerations, lots that may be changing in both the internal and external environment. So ahead of each year's reporting, it's something that you'll want to consider to ensure that you have the relevant information to support this determination at each point in time. Lovely. So I'll hand back over to Landon now to take us through the next segment. Thanks.
Great. After identification and evaluation, the third concept we want to discuss in this unit is integrate. As you may remember from the content section in the line unit, disclosures shall include a description of how climate and/or sustainability-related risk management practices are integrated into the holistic risk management processes. However, this is often an area where we get a lot of questions, so let's review this again. So some companies might already have processes for collecting the content described in the last module. For example, a company might already have processes for the disclosure of corporate governance information or the disclosure of risk management processes. In those cases, the company can adjust processes to integrate sustainability-related risks and opportunities, while in other cases, that company might need to develop new processes and plan for its integration into the company's processes over time. Some considerations to take into account when doing this is to start with a clear understanding of what processes need to be adjusted versus those that need to be created from scratch. This might sound obvious, but because, as we discussed earlier, the processes can often stretch across an organization, there already could be a process in place in another team that could be adapted. Then when assessing if an existing process can be adapted to consider sustainability-related issues, it's also important to assess its suitability and whether new prioritization criteria, controls, and contributors are needed. Another important aspect is to consider resources that are in place or that need to be added. Developing a disclosure plan is also a great way to integrate sustainability-related risks and opportunities into an organization's practices and processes. It can also help a company answer a number of important questions like what are the company's reporting goals and objectives? For example, to comply with laws and standards or to communicate management strategies. How will different goals and requirements be managed? Which audience or audiences does the company want to communicate with? Who will be involved in developing disclosures? For example, risk management, company secretariat, procurement, finance. It could be a range of different teams or departments. And then how will those individuals and departments be organized, and what will their responsibilities be? We've discussed data. How will data be sourced? Can you use existing systems and controls? And what about assurance? And importantly, what are the sign-off procedures? To bring this together, we have an example with Hammerson, a British property developer, which illustrates the basis on which the company is reporting. What's important to note here is that in order to develop a disclosure plan, you first need to understand how and what you're reporting. So outlining the regulations, standards, and practices you're aiming to achieve from the start will make it much easier moving forward. This information is also important to the users of your reports. They need to understand how you collected and processed the information so that they can understand what it means. Two otherwise identical companies could use different methodologies to define the boundaries of their business, and that could result in completely different results in their reports. Considering this, Hammerson provides the reporting period for the information. So you see covering Jan 2022, and then the approach and scope used for data collection and verification of all its reports, and some other helpful contextual information to better understand the data. So agreeing to this before getting started with data collection is essential so that the information that's collected is appropriate and correct and right, and that there's no surprises at the end. I don't think anyone or any company wants to be in a position where you're having to go back to recollect or collect information again. And an added benefit is that it also helps the readers of your report. We have a couple Zoom polls here. So first is a disclosure plan required by the IFRS sustainability disclosure standards. Yes, you must disclose your plan, or B, no, but it's a very helpful tool. And I'll pop that up on your screens now. So what do you think? Yes or no? Okay, a few more seconds. If you haven't answered yet, pop in your yes or no. Okay, we'll end the poll there. I'll share results. So this isn't atypical how folks answered. Often individuals do choose yes, that you must disclose your plan, but it is option B, that no, but it's a very helpful tool. So the reason we talked so much about it is because of exactly that it is a very helpful tool for folks. We have one more poll right now. 1 second, please. Okay, so second poll, A disclosure plan can help a company to A, B, C, or D. I believe for this poll, you can choose multiple options. So try to think through which makes sense here. A few more seconds. Okay, let's wrap it up there. So I'll end the poll and share results. So for this question, the correct answer was all but D. So well done. Looks like majority of folks got the right answer. So that's great to see. Well done. And with that, I'll turn it back to Fiona.
Thank you, Landon. So we'll be moving on then to a summary of Module 3. So you'll be pleased to know that's 3 or 4 modules down. So well done so far for your attention and engagement, as we recognise there's lots of content to get into here. So let's remind ourselves on a few key things we covered in this module. So connections, of course, is key. In the last module, we wrapped by highlighting the importance of connections between those 4 core areas of disclosure. And then in this module, we learned that there are many connections as well between a company and its external and internal environment. And these connections are what we need to focus on to identify key risks and opportunities. Then the second thing we came onto was related to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions and transparency as to what those are. And using a scenario analysis can be a very helpful tool, as it helps you to keep track of those assumptions in particular. And if you're new to this, I actually just responded to a question in the chat relating to scenarios, sharing some tools and sources that you might want to refer to, including the IPCC, the NGFS, and IEA. And we'll have some further resources on that front within your handout materials. And finally, as we've seen, even if some of the data is not your data you're already disclosing, you may already be collecting it for different reasons, or you may have more appropriate kind of actions or information that you have in place already to collect data that you want to report. So you might just have to adjust those existing processes and not need to start from scratch. So make sure that's something that you consider before perhaps going out and finding lots of new tools and information, is making sure you know what you already have that can support you on this. Lovely. So to wrap up the module, you've guessed it, we'll be doing another Menti exercise to get you thinking about these concepts. So Landon has reshared the link in the chat for you to the Menti activity, which should be showing the next question at the moment. And what we'd like to ask you this time is, what are the existing systems and processes for data collection that you could adapt to collect data on sustainability related metrics? So this is thinking both about how you will collect the data and also how you might manage it as well, and think about the governance and controls around it, or who's going to be accessing it and using it. So I will move through to the Menti now at the same link as before, and we'll see what you guys think about this point before we discuss some possible options from our side. Okay, so I'll just give people a moment to have a little think about that question and think about what they might have front of mind for them. So we have social media metrics. That's quite an interesting point to start on. But yeah, I think, you know, getting a sense of what your audience are engaging on, you know, what topics it is that they're interested in sustainability from an external standpoint, if that's what you're referring to there, I think is super helpful insight as to what those trends and factors are that should be considered by your organization. We then have the Task Force on Nature-Related Financial Disclosure, or TNFD recommendations, the LEAP approach. So yes, that is, if I'm not mistaken, a tool that really supports organizations to consider nature-related risks and opportunities, and particularly, and to get into analyzing those in quite a granular way. So that can certainly be helpful if nature and biodiversity risks are relevant to your organization's operations. We've then got operations data. Yes, exactly. You know, a lot of operational information within your business is actually going to be highly relevant here. You know, as we were talking about greenhouse gas emissions earlier, actually understanding those emission sources is a lot about understanding, you know, the core operations of your business. You know, how much of a product are you producing? What kind of transport do you have? You know, how much are you spending, etc. Then we also I'm so sorry, I'm actually getting a fire drill in the building that I'm in, so if it's okay, I will hand over to you, Landon, whilst this is happening. My apologies.
Yes, no problem at all, Fiona. There's always, you can never anticipate everything like a fire drill. So we'll wrap up this Menti, and oh, Fiona, are you good to continue, or do you need a pause?
I think I'm going to have to leave the building. My apologies. The alarm hasn't stopped. I'm so sorry, everyone. So I will need to pass over. I think it's Robert next, but I'm going to have to evacuate, I think. My apologies. Hopefully I won't be gone too long.
No problem at all. All good. Thanks, Fiona. So with that, we will turn it over to Robert from IFRS to take us through the next section.
Yeah, sure. Thank you, Landon, and welcome everyone. Indeed, we are moving to the next section, the last section of this workshop on the communicating with investors on what, where, and how the sustainability disclosures should be communicated with the external world, with all your stakeholders. So we'll be dealing here with some practicalities and admin information, which is, I think, very important, might be interested. So with this section, we will be then talking about three different topics: and allocation and timing of the report, efficiency, and confidence. So we will walk you through those three topics. And first, we will then be focusing on location, and so where the disclosures should appear and how that should happen. And before then, we will talk about this specific matters, or where this disclosure should be reported. We will talk about holistic reporting package, and so what we want to say here is that you should think about sustainability disclosures in the context of the complete reporting package that is useful to investors. And investors already have the access to companies' financial statements. ISSB standards are designing to identify sustainability related risks and opportunities that complement the financial statements. These come all together in a reporting package that we call a general purpose financial report. And the requirements of the ISSB standards about what information to report are based on existing sustainability reporting regimes, focus on investor information needs and on aspects of financial accounting standards. And ISSB and GRI reporting standards share some content requirements, for example, what to report, but the ISSB standards are focused only on investors' information needs and decision-making, reflecting the mission of IFRS Foundation to bring transparency, accountability, and efficiency to capital markets around the world. Both organizations take different approaches to defining materiality, but they are not competing. The GRI approach is set out and understood among sustainability practitioners, whereas the IFRS approach is familiar to accountants and relies heavily on management judgment, aligning with existing corporate risk management processes. A simple example is where a double materiality assessment identifies that some of the company's impact may also create sustainability risks. which could be so significant that they are important to disclose to investors. So with the next section, we will then talk, we already touched upon this, so this is just to bring it up again, to define what is material information. As we just noted, materiality has different definitions for different reporting standards and audiences. So let's briefly recap what we mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. Once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities. This is where our materiality definition comes into play. The definition of material information used in S1 is based on and aligned with definition found in IFRS accounting standards. And again, that's the information that if omitted, misstated, or obscured by other information could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosure of key information that matters to investors. With the next slide, I want to say that investors have asked for disclosure of material information, and the ISSB standards have been designed to help you gather to disclose it. However, this does not mean that company to disclose information that is not material, even if the ISSB standards include it as specific requirements. So again, the company does not need to disclose information that is not material. And so it's important to remember that material information is clearly identifiable and that you use plain language. Ensure that material information is not scattered across the disclosures, and include additional non-material disclosures if required by regulators to ensure it's clearly identified as such. And now we'll be coming to the Zoom poll number 11. All right, so in this Zoom poll, we're asking you to, the question is, information should be disclosed in the annual report when applying ISSB standards if, and then we have 3 options. Omitting that information could reasonably be expected to influence investors' decisions. B, it could reasonably be expected to affect the entity's cash flows. And C, it exemplifies the values of the leadership team. So let's wait a little bit more. So a bit more participants to allow to answer this question. So what is the definition of the material information? All right. We're sharing this results. So indeed, good answers. The good answers, the right answers are A and B. So the material information is that the one which omitting the information could reasonably be expected to influence investor decision, and also B, it could reasonably be expected to affect the entity cash flow. So this would define what the material information is. All right, and moving to the next. Oh, I'm sorry, that was the Zoom poll that we already covered. So coming to the next slide, it's about a question about where to report sustainability disclosures. And disclosures under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. But S1 does not say where in that reporting package the information should be reported. This is designed to allow jurisdiction-specific requirements on the location of the reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as a part of the same reporting package as the company's financial statements. Sustainability disclosures must be provided at the same time as the related financial statements, cover the same reporting period as the financial statements, and authorized by the same body or individual authorizing the financial statements. Research by the WBCSD on the state of integrated reporting shows that nearly 2/3 of companies continue to put sustainability information in standalone reports. However, the ISSB standards require material sustainability-related financial disclosures to be included with the general purpose financial reports. So that suggests that many companies have some way to go to get their internal processes and disclosures plans aligned. Now be moving to the example.
I'm back from my.
Are you back, Fiona? Perfect, great.
Sorry about that before,
over.
everyone.
Thanks.
Best laid plans, but false alarm, so that's good. So our example here is from Ayala, which is a Philippines-based corporation which works in property development and also quite a few different segments, so banking, healthcare, technology, etc. And here, this diagram depicts the company's value creation model, but this time it gives also a sort of table of contents which gives detail on each of the elements and then refers the reader to different areas of the report where they can get more information on these concepts. So locating sustainability related information alongside other information in the same category as they do here is a really good way of providing a comprehensive picture on how the business treats sustainability related matters in relation to other matters. So for example, how material do they consider sustainability risks to be compared to other types of material risk that they've identified for their business?
Thank you, Fiona, for this example. So moving to the next section, I'll be talking about digital reporting. Technology is an emerging consideration for disclosures. Increasingly, corporate reporting is moving from PDF reports towards information on web pages with structured data sets, such as those databases offered by stock exchanges. The IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards. So the taxonomy does not introduce any new requirements. A digital taxonomy provides elements or tags needed to make your sustainability disclosures machine readable. This makes it easier to take large data sets like information from entire industry and bring them all together by the analyst team. And digital reporting has a number of benefits. It makes the report information easier to use for analysis. Data is structured in the same across businesses in a machine readable format. Tagging information potentially allows for automated checks for quality and consistency. More and more data collection and management are compatible with digital reporting taxonomies, improving processing and the report preparation. Tags can have labels and descriptions in multiple languages. If you report your quantitative data in one language, someone speaking another language can also understand what it means. So these are clearly advantages of the digital reporting. So with that, we are moving to the next section within the communication part, and it's about how to communicate efficiently and effectively. Following the discussion on location and timing, let's now think about how to ensure efficient disclosures. We added this to the training because a common command we find from companies is that there is growing report burden. What we hope to highlight here is that when done correctly, efficiencies can be made to reduce the burden. First of all, it's important to understand what effective communication looks like and what is required. Often companies think that if they just put all the information they have into a report, then everyone will be satisfied. However, this would be against the core concepts, in particular fair presentation. For example, it could be helpful to ask these questions. Is the information clear and concise? And by clear, we mean might depend on the nature of the information. For example, whether it could be clearer to present information in tables, graphs, diagrams, plus accompanying text. And concise, to be concise, disclosures need to avoid boilerplate information, unnecessary duplication of information, and to use clear language. And while talking about the quality of information disclosed, some preparers watching tonight might be thinking to themselves that they still don't see what all the fuss is about. Perhaps their experience focuses on standalone sustainability report, or they haven't had much interaction with the external audit. To the accountants watching, I say be kind to your colleagues, help them to understand the difference in rigor that it is required in data collection, oversight, sign-off, etc., for the financial statements. This means, for example, disclosures include comparative information and are to be restated as necessary. Disclosures avoid unnecessary duplication and cross-reference as required. Information has to be material, be connected, and aggregated or disaggregated appropriately. So further, we'll be talking about the cross-referencing. As you may have already noticed, there may appear to be some overlap in the disclosure topics. For example, you might have the same governance approach for all sustainability issues. And rather to duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosures. And cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. The cross-reference information is assumed to become part of the reporting package. Cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. All right, and now we're moving to the next example. Over to you, Fiona.
Thanks, Robert. So here we have a cross-referencing example from CRH, who are a manufacturer and supplier of a lot of different products for the construction industry, and they're based in Ireland. So at the top of the page, the title tells us that the disclosure is about the impact of climate change and emissions reduction targets and how these have been considered within their financial statements. Then in the first paragraph, they talk about where we can find the risks identified in TCFD disclosures, and they tell us how those risks and the reduction efforts have been considered in the preparation of their financial statements. They then tell us that there has been no material impact on the financial statements as a result of those risks. They include the judgment that's been made using the company's accounting policies, estimates, and underlying assumptions. Then on the bottom half of the page, they tell us what parts of the financial statements they have looked at to consider whether the risk has any impacts. And they list the different items such as their impairment testing and cross-refer to the different pages of the financial statements where further information on those items can be found. So even though they're basically saying that there are no material impacts, it is useful for investors that they've actually explicitly provided this disclosure and they know how and where they've specifically considered climate risks and opportunities within those financial statements. And then within our handout materials of this presentation, there will be a few additional slides that you can refer to here for your reference, which consider the concepts of consistency and how you can aggregate and disaggregate data. So feel free to look at those ones in the handout for some further information on those points as well. Thanks, Robert.
Thank you, Fiona. All right, and now we're moving to the next part, which is about the mechanisms that support adoption, which might be this information relevant for smaller companies or with limited resources, or the one at their early stage of the sustainability reporting. And with that, we want to say that we have sought to apply a number of mechanisms to support preparers to get started with the ISSB standards. One simple thing to put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from the IASB, for example. And many requirements from in S1 and S2 are to be applied proportionally, recognizing companies will have a range of capabilities and preparedness on these issues. For example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information and the reporting date without undue cost or effort, or consumer rate with skills, capabilities, and resources in number of places. There are also applicable reliefs for the first year of the application, and have this one been introduced and includes, for example, companies being able to limit disclosures to climate in year 1 and begin reporting on their sustainability related risk and opportunities in year 2. Companies might also be able to provide annual sustainability related financial disclosures with their next half-year reporting, rather than the same time as the financial statements. And thirdly, companies not needing to provide disclosure about scope 3 greenhouse gas emissions apply to the greenhouse gas protocol corporate standard to measure emissions if they are already using a different measurement approach, or provide comparative information in the first year of reporting using S1 or S2. Another relief allows companies to include greenhouse gas emissions information obtained from companies in the value chain with a different reporting cycle. We have mentioned a number of other sources of guidance and resources, including ISSB standards, CDSB framework application guidance, among many others. These reliefs are designed to enable companies to put in place reporting practices and structures to provide high quality decision useful information. But jurisdictions will finally decide when to mandate adoption, but the standards are effective from 1st January 2024, and we know many companies are now preparing to adopt them voluntarily. With the next section, we'll have 2 Zoom polls. And the first question is, information disclosed in accordance with the ISSB standards should be, and we have a couple of options, should be decision useful, should be material, should be misleading, should be comparable. Let's give some time for the participants to participate in this Zoom poll. All right. Yeah, I think this was fairly straightforward and well done. Yeah, it should definitely not be misleading. So the correct answers are A, B, and C. Should be decision useful, material, and comparable, and not misleading. We can come to the next Zoom poll. The next one, 13. All right, and the next Zoom poll is about information useful, and that the information is decision useful if it's relevant and faithfully represented, comparable, verifiable, timely, and understandable. Great. I think with this one, we have also a really good response. All the correct answers all the answers are here correct. So information is decision useful if meets all these criteria. So it's relevant and faithfully represented, it's comparable, verifiable, timely, and understandable. So well done with this one. All right, and now we're coming to the next section about confidence. So we'll be talking about how to maximize the confidence in disclosed information. And in this last section of our last unit, we will look at how you can ensure that the users of financial reports have confidence in the data you are disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so with the growing concern over greenwashing. So we're talking now about comparative information. An important trust builder is showing data and trends over time. This is why the ISSB standards ask for comparatives. Comparative information provides context, helps to indicate progress, and underpins strategy and risk management. Metrics disclosed by a company might be redefined or replaced over time, or the company might change its method for estimating a metric. In these situations, it is important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. Occasionally, a company's sustainability disclosure might contain material errors. In this situation, the company is required to restate these errors in the comparatives provided. Revisions or restatements are necessarily only where there is a risk that material information being omitted, misstated, or obscured as a result of not receiving or restating the comparatives. Information can be qualitative or quantitative. It's important to know that companies sometimes express concern with sharing the information that they deem to be sensitive, or that if shared could deplete their competitive advantage. The ISSB standards relieve a company from disclosing information about sustainability-related opportunity if that information is commercially sensitive. If this is a concern you have, there's a further detail you can read in the handout. Yes, and finally, it is important to build confidence by providing clear statement of compliance. A company that complies with all requirements in the ISSB standards, even the reliefs, is required to make an explicit statement of compliance. We are publishing further guidance on this topic, as has been actually published on voluntary application of ISSB standards. I think we can post a link to this document in the chat box. So this is also might be a helpful resource. All right, and this at the end, some things to remember. Please walk through the list of these key takeaways from these sections. You can find in the handout slide deck an additional slide in this section, which or with reminders on how to report effectively, and I highly recommend reviewing that. And that's it from me. I'm handing over to Fiona. Thank you.
Thank you very much, Robert. So brilliant. That brings us to the end of our fourth and final module. You might be slightly relieved to hear, because we appreciate this is a lot of content, but we hope it's been a really helpful overview. So before we get you to do another exercise, we're going to close by just wrapping up and taking a moment to recap what we've covered in this module. So firstly, we discussed where to report information. And what was important here was the audience, or who you're reporting to. So make sure to be clear from the start who the primary users of information are. And what will help you there is ensuring that this information is really right for their needs and providing a really clear focus on what to report for their needs. We then talked about efficiency, and I think the key takeaway here is really that less is more. The objective isn't to overload your investors with information, because actually that can be harmful because it can obscure the information that actually is required and is material. So you need to use the standards to get you started and use them as a guide to make sure that you're providing information that your investors really need, which of course is the primary purpose of the ISSB standards. And then finally, we discussed report user confidence in your data, especially in the current climate of greenwashing accusations and some legal battles over public statements by companies. You want to ensure that your data is not only accurate, but it's represented in a way that builds confidence among report users. And so the reporting plan that we've been discussing here can really help you with this if it's done well, and it will give you a clear and documented process for reporting the data needs to investors. So as we did establish earlier, a disclosure plan is not a mandatory requirement of the standards, but we really do encourage you as a voluntary exercise to use that to really help you structure your approach. So this brings us to our final Menti activity before we wrap up the session. So to get you started on this communications aspect, we want to take a moment to think about what techniques you find useful in a report to find the information that you need. So obviously some reports can be as long as 50 to 200 pages. And how do you make that easy to navigate? So here we could be thinking about both the presentation of the information and also the techniques for navigating that report. So we will turn over to Menti again now. You should have the link as previously, and I know Landon's reshared it, and then I will share my screen and hope that this isn't the bad luck timing of when a fire drill starts that this activity happens. Let's hope not. But let's see, a few people have already come back to us here with some ideas, so thank you for sharing those already. So we have infographics. Yes, absolutely. So visualizing whatever you can within your reporting to support navigation and get across key concepts is really good. And so I think some areas that really lend themselves well to this can be relating to your business model, your value creation model, and perhaps your risks and opportunities as well. And I think we start to see some really good techniques as well from companies regarding how to present their emissions reporting in this way as well. So we have the Edge Buildings, an IFC build environment project. So that's not one I'm familiar with, but that's really great to have highlighted that as a particular built environment example. Thank you. So summarizing things, highlighting the trends. Yep, absolutely. All good ideas. Tables, exactly. I think sometimes we try and come up with more intelligent ways to present things and think a table actually is too simple, but actually simple can be best in some cases, and particularly for investors. I know that quite often just a nice data table that they can use for their own purposes can be very helpful. So we also have integrity and investigation of the data relating to IFRS. So yes, keeping in mind that confidence and audit process that you may have internally regarding how you've collected that information. So we also have using techniques like headings, bullet points, summaries, and visuals, having a table of contents, consistent formatting and hyperlinks. Very good. I think those are all great answers. And I think that consistency, as you say, so you're using headings that speak to the terminology that we'll recognize from the standards, and that you're being consistent in how you report upon each of the different sustainability issues is very helpful. And case studies, of course, those do, and real world examples indeed really bring to light and show what you're doing. I think what's important to do with case studies is to make sure that those are, really representative of your practices, because obviously sometimes that's where it can be a challenge for companies if it feels like they're selectively highlighting just a small aspect of their business. But if you have meaningful case studies that really zone in on a particular area of risk or opportunity, that's absolutely very helpful. And avoiding jargon, exactly, often quite a challenging thing to do in this complicated field we're in, I know, but as much as we can, speaking in simple language and organizing things visually with good summaries. Lovely. Thank you, everyone. Those are all great responses. I think you've really highlighted a lot of what we would have identified there as well. A few things maybe that we would just highlight additionally would be using cross-referencing tables. So for example, showing a correspondence of your information to a particular standard and allowing users to know where they can navigate within the report for that. Also perhaps having a bar or navigation pane in your report that helps users to know what section they're in and hyperlinks to other areas. And then also thinking about options in terms of digital reporting. So beyond just having a PDF version of your report, actually can you make it more interactive in the way that the report works, or consider more digital tools that can support usability there. Lovely. So I will just move on to a final Menti or two before we close up the session. So coming back as we started with this question about your comfort on these different aspects of our learning objectives, it would be really great for us just to get a little bit of a sense of where you feel that you are now against these areas. So just take a moment and think, do you think that your understanding and comfort on these key areas around explaining what ISSB is, using the ISSB standards, and developing your reporting strategy are in a better place? Brilliant. So I see we have some responses coming through, and great to see that we've now kind of shifted along that scale in your understanding. So that's brilliant. I guess unsurprising to see that the explanation side is coming out most strongly, because of course that's the key starting point, but I think it's great to see that coming through as a strong feature, because of course that's where you can really then start to get others on board within your organization to help you on those latter two aspects. So thank you. And then I'll move the Menti along to this question here, which I will leave with you to consider in your own time, but do please feel free to take a moment to share with us your thoughts on what was good about the training, or any areas you might like to see, which we'll also cover in our feedback survey for you as well. Super. So moving back to the presentation, which I think we'll just be getting up in a second, we have a little bit to talk about with you in terms of the homework assignment. So as a reminder, I guess we've finished our interactive time together today, but of course this is just the beginning of the learning journey on this topic. And what's really important, and is what's really going to bring this to life within your organizations, is how you really apply this and take this forward. And this is really what we've developed our homework assignment with in mind. So as we've said, it's an optional exercise for you to take away. But if you look on the event page for this event today, and as we've shared in the chat box, you'll be able to access that assignment. And it really takes you through a similar structure as we followed in the Menti exercises, but gets you to consider those 4 areas of prepare, align, implement, and communicate. And so if you follow through that structure, we hope it will help you to develop your first ISSB aligned disclosure plan and really allow you to put things into action. So we definitely encourage you to take that away, and also to share, of course, with your relevant colleagues who you might need to gain input from to help you with that further. So, of course, this, as I've mentioned, is not the end of your learning journey. So we would encourage you, of course, to continue your learning using some of the resources we've highlighted. So to mention a few of the key ones, we have the IFRS Knowledge Hub. This is going to be a really important resource, of course, for the ISSB standards, and it's regularly updated with new resources. So one to definitely check out. Then from the standards, of course, themselves, clearly the Bible here that you should be referring to with regard to these issues. So make sure that you are indeed going back to the source with the standards themselves. And then when we move along to the IFC, this is a really great resource to share. The Beyond the Balance Sheet work program that Relita's team lead provides a really comprehensive toolkit of resources relating to sustainability, governance, and disclosure. So it really helps you to think about how to bring these practices to life and to practically implement them at the different levels of your organization. And finally, on the resources front, of course, we would just highlight from the SSE side that we're working really closely with the IFRS Foundation and our partners to support stock exchanges in particular on this topic. So for anyone who missed the start of the session, just to recap, here are some of the key toolkits that we would recommend that you refer to, and which I know Landon is linking things again to you in the chat. These kind of documents can be really important. And as a reminder, we are open to exchanges booking onto our other training programs relating to gender equality, etc. So please take a look at that as well. This training, as we said, is generously funded through our partners, and so is provided at no costs to exchanges or participants to deliver. So definitely encourage you to share that with your network as well, that opportunity is there. We mentioned previously, but a big well done for getting this far through the training session. We very much appreciate the time and attention that you've given to this topic today. And as a token of our appreciation for that time, you are eligible, if you have participated in this session live, you will receive a certificate of participation. And to get that certificate, what you will need to do is to complete a feedback survey using the link which has just been shared with you in the chat. You'll also get sent this link tomorrow in follow-up via the Zoom event in case you miss it here. And so what we need you to do, if you'd like your certificate, is to fill out that feedback survey, and that certificate will be sent out to you in follow-up. Please do allow a week or so to receive that certificate because it sometimes takes a little time to process those, but that will be on its way to you very soon. So with that, all that leaves me to do is really to offer our final thank yous. So of course, starting with our ISSB supporter network, who is a group of stock exchanges and organizations really promoting sustainability in capital markets and who make this training possible. So a big thank you to that network, and a big reminder as well that those supporters do receive early access to all of our training programs. So it's well worth the stock exchanges considering being something that you sign up to in future. And of course, we'd really like to express our particular thanks to the Dar es Salaam Stock Exchange team for hosting today's session and providing such great support to organize this and bring you all together today. So big thank you again to the team at DSE. And finally, just to say a final thanks to our partners at IFC and the IFRS Foundation, especially Jarlath and Robert, for all of the great resources they've shared with you today and their knowledge in the Q&A responses. So with that, we will be leaving you there. So a big thank you to you again for joining us. We really appreciate it, and we hope you have a great rest of your day. Thanks a lot, everyone.
Thank you.